Wealth Breakthroughs is an exclusive video series where millionaires break their silence on their usually hidden secrets on how to stack up great wealth. It's like eavesdropping on the private conversations rich folks have with each other behind closed doors. But I've partnered with the series creator Jeff Hays to bring that VIP pass to you right here today. In this episode, you'll learn how to structure a portfolio that pays you $50,000 per year, how to overcome your fear of investing, the simple steps to make money work for you on autopilot, and how to legally cut your taxes by 20%. Get ready for a wealth building journey. Today is dedicated to turning your dreams into opportunities for financial success. Enjoy.
Hello and welcome to Wealth Breakthroughs Episode 6. I'm Patrick Gentempo. Author, speaker, investor, and entrepreneur, Andy Tanner's life is about pure hustle. He's energetic, engaging, and our interview could have gone on for hours and hours. In today's first interview, he's going to show you how to build a profitable investment portfolio no matter how much money you have to begin. 4 steps hold all the magic. Follow Andy's instructions and you have a ready-made wealth breakthrough. He'll show you how to structure a portfolio so it eventually pays you as much as $40,000 or $50,000 or more a year in dividends. There's no sense in holding back. Let's get started. Andy, very much looking forward to this conversation.
So great to be here. Thanks for having me.
So tell us a little bit about your background. What got you into doing the work you're doing today?
Well, growing up, I was one of those lost kids that didn't know what they wanted to do. Grown-ups tell you to get good grades, find that job, and I never really found my way there. I'm a big guy, so luckily I could foul well enough to make a basketball team.
How tall are you?
I'm about 6'8".
Yeah, wow. Yeah, so you walk in, it's like you look up.
I don't tell people how much I weigh anymore. But that was about 100 pounds ago. Wow. So, but it was interesting because when all that was finished and done, I really didn't know what I wanted to do. And I found myself in sales. And I got really good at sales and business. And I, learned how to pitch things, so to speak. And I ran into a company that was selling a software on trading. And, the internet had just come about, and I got really interested in that. And as a result, I started using it, started learning about it, and moved away from there into being an educator and investor. So, things just worked out and landed in a really nice place.
So when you say an educator and an investor, obviously you do your own investing, but you also are educating other people on how to do it.
So the education part came, because it's something I very much enjoy. And as I got to know more and more teachers and mentors, they were kind enough to ask me to join some of the things they were doing. I've been a Rich Dad advisor for Robert and Kim Kiyosaki for 10, 12 years now, and that's just been a wonderful adventure, learning from them and then passing on the things I've learned from my mentors and also experience, both good and bad.
How important is a mentor in the process of becoming a good investor?
I think it's everything. If you look at the greatest investor in the world, Warren Buffett, you look behind him and Benjamin Graham is right there. Robert had a rich dad. Almost every great investor I can think of had someone that taught them how this worked. And so I don't think there's any guarantees when you invest, but having a great mentor to talk to question, to guide you, that's really what the book Rich Dad, Poor Dad was all about. It was a book about having a rich dad, a mentor.
And I guess on the flip side, having the wrong guidance, or let's call them the anti-mentor. Yes, somebody's mentoring you, but giving you bad advice, that can also send you in the wrong direction.
Sometimes that's trial and error. You take a punch and say, "Boy, I shouldn't listen to this guy." But that's a huge point you make, though, about mentorship. As a Rich Dad advisor, I get asked a lot about Robert and Kim and the Rich Dad, Poor Dad and that whole series of books. And I remember I ran into it like anybody else. A friend of mine gave it to me in the 90s, and I read it. And we thought it was about buying assets. We said, well, we'll stop buying liabilities and we'll go buy assets. And we set out to buy real estate. my wife and I, we bought zero real estate. I mean, once we got into the details of it, we were unsure, and the fog of concern came in. And I remember she said, let's reread this book and see what we missed. So we sat down to read it, and she looked at the cover and said, I got it. I said, what do you mean I got it? She said, hey, we've both got poor dads. We're halfway there. All we need is the rich dad. And when we made that transition from searching for deals to searching for people that could help us, that made a huge difference. So I can't say enough about the importance of working as a team and finding the right teachers.
That's actually pretty fascinating, that you had that realization, because a lot of times people think it's, maybe just add water. Okay, here's the advice. This, you do this, you do this, you do this. And I think having a process, a template to work from is a good thing. But you stopped and said, I got to go find a mentor. So how do you go and find a good mentor?
I think when you look at advisors and mentors, they're very similar. Advisors are like accountants and attorneys. I think you talk to the people who do what you'd like to do, and then ask them, who their advisors or mentors were. That's, I think, the most surefire way through a network or someone that you know and trust. When they recommend someone, that's a good sign. If someone successful says, if Warren Buffett says, yeah, I read Benjamin Graham's book, he was my great mentor, that's a clue. Yeah. That's a clue for sure.
That's great. So what's your philosophy on investing? How do you approach it from maybe the high level, saying, this is the way I see things?
Sure. Investing is about investing wisely in making transactions. And this is not something that we have in school. We have economics and finance, but investing is different. And when Robert asked me to write my book in his series, it forced me to answer that question. What is investing? And I've come to believe that there's 4 things that make up investing, or at least a wise investor. The first 2 have to do with gathering information. For jargon and fancy terms, we call this understanding things fundamentally, or what you call a fundamental analysis. So the first lessons of investing, I would say, is the ability to look at a deal and understand its numbers. Can I look at a church, and is it doing well? Can I look at a nonprofit, a government, a stock, or a real estate deal? When I look at its income and its expenses, its assets, its liabilities, when I look at those numbers, do I understand them well enough to say, well, at least it's surviving now, at least it's headed in the right direction? So that'd be the first one. The second thing I would say of the 4 is also information gathering. We have to be aware of trends. Trending is a huge thing in business. We don't want to react too much to every little blip. That'd be silly. But to understand the general idea of supply and demand and where things are headed is a huge advantage. So with those 2 things, we have information. The third thing is critical, is that's where we begin to take some action in how we position ourselves. For example, not much I can do about a report that comes out on a particular stock. The numbers are what they are. But I can choose how I position myself, whether I'm long or short, or want a cash flow, or how I want to place my money in the way of success, so to speak. And then the fourth thing is the one that I think is the most important thing to learn in investing, and that's the idea of managing risk. Those numbers, people think it's about predicting the future, and I tend to think less so. I think trends are important, but dealing with sudden change, when you can do that, then you can invest with confidence, knowing you have a plan B. That's we spoke last time about 401ks, and that lack of a plan B bothers me the most. Is if you have a systemic issue, what are you going to do? So having a plan B and knowing how to adjust. So those are the 4: looking at numbers, fundamentals, looking at trends. Some people call it technicals. Positioning yourself for cash flow, and then finally risk management. And in a nutshell, those are the 4 things I think about when I'm going to make an investment decision.
Can you give me an example of what you mean by a plan B?
Absolutely. Insurance is a good plan B. In the stock market, we call that a hedge. And the idea is, if we, you would never put money in a home without insurance, because it could burn down. Now, you and I We don't think our house is going to burn down today. We don't think it's likely. We're not predicting that it would burn down.
Right.
And yet if it did, no one would claim that we're geniuses because we bought insurance. Well, a more specific example that I often cite is Mark Cuban. And I don't remember if we talked about this before, but even so, it bears repeating. Is Mark Cuban had a company called broadcast.com. And, you know, broadcast baseball games all over the world. The internet was brand new and sexy. And a company, search engine Yahoo, came to him and said, we'll give you, $6 billion of Yahoo stock for this company. And he said, yes. And that was around, always probably $100 a share. Well, within a very short amount of time, it's worth $5. And yet Cuban still owns the Mavericks and is rich. And he was on 60 Minutes with Steve Kroft. And Kroft says, how'd you do it? You trade all your money for this stock and it goes to zero. How come you're still a billionaire? And he said, well, I was covered. I was hedged. In other words, he had purchased some contracts that were very much like insurance contracts that allowed him to sell at a high price, even though it came down low. And Steve Kroft says, well, he was a genius. I says, well, not really, because if he thought it was going to go down, he would have sold for cash instead of stock. The only reason you sell for stock is if you thought it was going up. But the fact he had insurance made him look smarter than the average person. But in reality, he's no smarter than you and I insuring a home or a car. So there's lots of different plan Bs. There's insurance, there's exits, there's position sizes, a lot of different ways to manage risk.
So furthering that scenario, what percentage of the position, let's say you're long on a stock, what percentage of that position would you be spending on this type of insurance you're talking about, saying that if it were to really fall, that you're protected?
Yeah, it's a great question because insurance is going to eat up profits. There's no question that if I'm a speculator on a home and I insure it, that it's going to eat up some of those profits. A good example would be the ratio you spend on a rental home to insure it. So in the stock market, it's going to depend on the stock, but I'll give you a good example. I might have a position that is $100 a share. You could hedge that with a decent hedge for 5 cents, 10 cents at the most, if you were far enough out of the money. So it really depends on the deductibles you want to pay and the premiums you want to pay, but having something there, I think is a wise choice.
So in that scenario, 5 to 10% of the total position value?
I'd say much, much less than that. I'd say maybe 0.5%.
Oh, I'm sorry. I was off by a decimal point. So 0.5% to 1%, which obviously not a bad investment to protect the downside.
And the other thing is that unlike I don't need to, having a plan is different. I don't like to compare asset classes because I think it's unwise. There are people who say, oh, you don't want to be in business. That's a terrible idea. Most businesses fail. Or say, oh, if you're real estate, you'll be unclogging people's toilets. And I don't think that a guy like Kenny McElroy or Robert Kiyosaki spends their time unclogging toilets. Oh, you don't want to be in stocks because it's so volatile. If you look at those differences, though, with that said, one of the nice things that paper assets have, like stocks and options, is they're extremely liquid. So if I see a rental property and it starts on fire, I can't pound a sign that says, fire sale, hurry up, I can sell. I better have insurance in place. But in stocks, I can have a plan to hedge without having hedged. And if things start to heat up and start to happen, I can jump in very quickly and protect myself. Most people don't know how to do that. And so I can be very reactive, very, very quickly, and we can neutralize things almost immediately. So we might not make a lot of money, we might not lose a lot of money, but we can always neutralize the position at will. So it isn't like I have this formula where I have to say, well, X amount of my profits are going to go for protection. Even having a plan and knowing how to deal with a fire is a great insurance.
So do you have a philosophy about investing for cash flow?
Yes.
And can you invest for cash flow in the stock market?
Absolutely.
All right, walk me through that.
Okay. Well, there's an easy way and a way that's a little more complex. Let's talk about the easy way first.
Okay.
I think the greatest example we could start with would be the greatest investor of all time. That'd be Warren Buffett. And
Why do you think he's the greatest investor of all time? Just based on his results that he's created, or what makes that statement?
I think I'm kind of biased because I study him a lot, so I kind of get a little starstruck when I talk about him. But number one, you mentioned his results. I mean, he has amassed a tremendous amount of wealth. He's given as much to charity as anyone I know ever on planet Earth. I don't know anyone that's given away more money than he has. His percent return has been phenomenal throughout his life, and he's done it consistently for 60 years. I think the greatest thing I learned from him is his temperament. He's got an incredible temperament.
How important is that to investing?
Well, it's everything, isn't it?
Is it?
You know, Robert Kiyosaki says it this way: when emotion goes up, intelligence goes down. And if you and I look at our own life, you know, when we've done things we shouldn't have done, chances are we got emotional. Now, the way Buffett says this, he says we like to be fearful when other people are greedy, and greedy when other people are fearful. And the ability to keep cool, and as you look at him historically, you know, the U.S. bank play that he made and the different investments he's made, he's been a cool cucumber and being able to seize opportunity when everybody else's hair's on fire.
Yeah.
So temperament, I know when I've made mistakes, Buffett's more like he's like the roulette wheel dealer. He doesn't exclaim at a win or a loss. You know, when the roulette dealer loses, he doesn't say, "Oh no, let's shut it down." And when he wins, he doesn't exclaim. He just says, "Keep it rolling, boys. We have a system. Keep it rolling." It's the gambler that tends to exclaim. And so, but Buffett is a cash flow guy. People don't realize this. If you look at, he's the largest owner of Coca-Cola. And what's fascinating about Coca-Cola is he started buying that in the 80s. I think his cost basis in those days was about $3. Well, his dividend on that's about $1.50 now.
Wow.
So that's pretty good ROI. That's pretty good cash flow that he's earned, and the secret of that was cost basis. He has investments right now that he's paid full price for. Apple, he's he's investing more in Amazon, but in Apple, you know, that's a dividend stock now that gets his attention. So all a dividend is if you owned a business, you get a share in some of those profits.
Right.
And there's ratios where you can see what percent of the earnings go back in the dividend. And because Buffett buys at low prices, his cost basis is higher. You know, I don't know what Coke would be today. I mean, if you bought it at today's price, you're not going to get near 50% on your money.
Right.
But the wise investor finds ways to reduce cost basis. There's opportunities. I probably shouldn't yell out companies now, but a good example right now is if you were to look at the analysts at Kraft Heinz, for example, they're saying run for your life. You know, it's down half, and it used to be in the 70s, and now, you know, the SEC's investigating them and all this type of stuff, and all the analysts are running. You know, 6 months ago they all said buy, buy, buy. Now they're saying sell, sell, sell. And if you look at that, they were telling you to buy it when it's high, and now they're telling you to sell it when it's low, which is the opposite of what Buffett does.
Right.
So almost every analyst that sells Kraft Heinz, well, Buffett owns 23% of that thing.
Wow.
Or something like that, you know, about a fourth of it. And they go, "You going to sell it?" And he goes, "No." He goes, "Why?" He goes, "Well, I cash flow about $300 million a year from the dividend."
Right.
And the funny thing is, his cost basis is higher than what you and I can get it for right now.
Wow.
So it's interesting.
It is interesting. And I think, you know, what you're saying is that a lot of this is driven by emotion, not necessarily. So if you got the cool cucumber over here doing fundamental analysis, and then he's seeing these emotional people running from stocks because of something in a headline, he's saying, "Oh, let me stay calm and take advantage of the situation." Yeah. And that's where he's getting greedy when other people are scared.
For sure.
I guess.
If you took those four things I mentioned, if you looked at it fundamentally, they have some problems. They have a lot of debt. That's their biggest problem. They got a lot of debt, and you know, their sales on some of their brands are tough. But you're looking at, you know, Oscar Mayer and A1 steak sauce and Kraft macaroni and cheese, and I still think you're going to see Heinz ketchup on the table. So we're trying to look, you know, 10 years from now. This year, they might have some bad earnings. You know, we might be able to pick that thing up at $15 maybe at some point. How awesome would that be? So that temperament is when the price is that low. The key is I'm not scared to jump in because I know how to get out if it goes lower. And so when all those analysts say, oh, run, it's terrible, the earnings are bad, everything, you know, the trend is down, everything's bad. I say, well, I don't care about throwing a bunch of money at that, because if I can get out of it and I have insurance for it, well, if it drops a little, I lose this much. But if it recovers, now I can have a low cost basis like Buffett had in Coke.
Right.
So you can't do that without all four, without knowing how to get out if it doesn't work out. But yeah, Buffett's a cash flow guy. I mean, he brings in about $6 billion a year in dividends simply from profits. So if you're a real estate investor, you know, I have a small amount of real estate, nothing like Robert has, but you know, I like that income that comes from the profits. Well, stocks are the same.
Right.
People buy a Coca-Cola and I get a little bit of that profit.
So do you buy mostly, if not exclusively, dividend paying?
Not at all.
Oh.
I very much, you know, Buffett has some stocks that do not pay dividends as well, where he's looking for probably growth, and then an eye that someday they might go from a growth stock to a dividend stock, for sure. But the second way that I really, really enjoy is I love the options market. So let's talk about this, because this is risky business.
Yeah, is this the complicated side that?
Yeah, a
you're
little
doing?
bit
Okay.
more. I wouldn't say advanced, but certainly intermediate. So think about this for a moment. Let's talk about insurance. Do you want to be a buyer of insurance or seller of insurance?
Seller.
For sure,
Yeah,
right?
yeah.
Geico, Buffett owns Geico. He gets this because what is insurance?
Well, you're basically calculating risk and making sure that you're going to have a profit at the end of the day after you collect all the premiums.
So what are your raw materials? What are your manufacturing costs? Your
None of
shipping
that.
costs?
Yeah, it's a service.
It's a promise.
Yeah.
Think about that. I promise you I'll fix your car if it wrecks, and you pay me for that. I promise you I'll fix your house if it floods, and you pay me for that. So if I'm smart, certainly I'm going to have some claims. If not, it wouldn't be value to the customer, right? But think about that. As long as the premiums are greater than the amount of claims, it may be the world's perfect business, because there's nothing but air there, promises. I have a little money backing up that promise, and that's it. There's nothing else to that business. Well, in the stock market, there's some wonderful opportunities in that idea. Except when we get to keep the promises, it's almost good. I'll give you an example. I mentioned that Warren Buffett owns a lot of Coca-Cola. Well, a lot of people don't know how he bought a lot of that Coke. What he would do is he would make promises to people that owned it, people that would panic and say, you know what, if it goes down, I'll buy it from you. I'll give you that insurance policy. Because here's the difference. If I promise you to pay you if your car wrecks and your car wrecks, well, I'm out that money and you keep your car. But if I promise you to buy your stock if it falls, and I keep that promise, I now own your stock. So one of the things that a very little known secret that Warren Buffett will dabble in is he will sell options as insurance. And he'll say, hey, if this thing comes down to a low level and you're nervous about it, I guarantee you I'll buy that from you at a low price. And people pay him to do it.
And are they obligated to sell him?
They're not. They have an option. They're not obligated.
Okay.
But here's what's beautiful. Let's say the stock goes up. Warren keeps the premium. Say the stock goes sideways. Warren keeps the premium. Say the stock goes down. Warren keeps the premium, and he gets to buy the stock lower than it was yesterday. So in all three scenarios, he keeps the premium.
Right.
And when you work the numbers on that, it's pretty nice when you compare it to other investments. The problem is it's not for the uneducated. If I could communicate two things, the first thing is you talked about the importance of mentors. We shouldn't leave that idea ever. We always have one eye on that. The other thing I would say, if anyone's going to listen to one thing I had to say, is we have a culture of advice. In other words, most of the people watching this program are hoping to get someone to tell them what to do. Andy, should I buy gold? Should I buy Bitcoin? Should I buy real estate? Should I buy oil? Should I buy stocks like you? Tell me what stock to buy. Tell me what to do. There's very, very, very small amount of people who are sincere and honest about getting smarter. If I say go buy gold, you're not any smarter. But if I say gold is fungible, now you're learning things. And so I'm very passionate about drawing people to me. The people that I tend to draw are the people who want to get smarter. The people who want to learn how to fish for real and don't get caught up in well, here's a fish that'll make you $1 million and all that type of thing. So those are the two cash flows in stocks. There's two great examples is you can collect money for profits, dividends. They divide the profits up, and you can sell an option, an insurance that allows you to buy more or sell at a high price if you want. And those are two great examples of monthly cash flow. I was just this morning going through some of my own investments over the years and adding up years and years of premium selling options. I was just showing my wife, and it's astounding how it adds up over the years. It's not going to be a venture where someone exclaims and got rich quick overnight. It's a cash flow deal. Big turns, big money. Cash flow is just nice and consistent, and it grows, and that's where we like to hang out.
So how much time do you have to spend to personally manage the stuff you're doing with options and other investments?
Me personally, not much. Generally, the way I do it is I have a business partner that I trade with, and every Monday before the market opens, we get online together and have a way to connect each other, and we look at our account together. And we make the major buys and sells and the plan for the week. And that meeting takes us, usually anywhere from 30 to 90 minutes, depending on, market volatility. And certainly we have plans throughout the week of all three directions. If something goes up, this is what we'll do. If something goes down, this is what we'll do. If something goes sideways, this is what we'll do. And I'll tell you, that gives peace of mind. Because in reality, we've predicted the future. Think about that for a minute. We predicted a future of up, down, and sideways. We got a plan for each one, so we rest easy.
Yeah.
So when people say, Andy, where do you think the market's going to go? I says, I don't know for sure, but I'm making a plan all three ways so I can sleep at night. And so the maintenance of that account is minimal. If it doesn't move, we're fine. If it goes up, all those adjustments are made. Now, there are people who love this. To day trade, and I don't, I get up in the morning, load up with coffee and go crazy all day. But for me, a good 30-minute to 90-minute session on Monday seems to work out real well for us.
How much money does someone need to be able to start this process saying, I want to go into the market, I'll spend my time, you say, getting smarter, maybe I'll learn about options and figure out how to trade those.
It's a fair question.
And then or maybe I just want to start buying some stocks. Some people might say, well, I've only got $20,000. I don't think I have enough money to make anything worthwhile out of this.
So I've been interviewed often, but one of the things I was taught, they say, don't answer the question you're asked, answer the one you wished you were asked.
Okay.
So I'll flip that just a bit.
Go ahead.
Someone might say, Andy, what would be the ideal amount?
Okay.
And the ideal amount would be about $20 billion. So that'd be nice. And the reality is you pretty much got to start where you are, right? So whatever amount you have is what you have, regardless of what the ideal amount would be. Now, to answer your original question, most brokerages like to see a person come with a couple of $1,000s to start with. That'll get you a margin account. And without education, that can get you in trouble.
Right.
Some are as low as $500, and a lot of them will let you just sign up for an account and let you practice on paper till you get good at it, which I think is the best amount to start with me and my students. Like if someone say, Andy, I want to be one of your students, I'd say, well, the amount you're going to start with is zero. And the reason is I don't allow any of my students to trade real money until they practice on paper for quite a while. Because what I believe is that if a person learns to do this on paper with zero money, and all of a sudden they see some results, money comes out of the woodwork. Because a lot of those liabilities and doodads they used to buy, they realize, hey, I'm losing money when I put that new deck on the back of my house, or I'm losing money when I go out and buy those designer shoes, or I'm losing because I could have been putting it here and having it grow. So the short answer, a couple of $1,000. The best answer, zero. Start risk-free. It doesn't make any sense to start with money at risk. And again, the advice people will say, well, I just want to go make money. But the education people will say, I get that. That's smart. I'm going to learn with no risk.
And are you buying and holding for extended periods? I mean, what's the time horizon? Obviously, you don't want day trade. You know, that's like crazy.
Yeah.
Crazy land. And,
it's not what I like to do.
Yeah. So, but do you like to have points where you want to exit a stock once you make a certain amount, or is it something you say, that's a dividend-paying stock, I'm going to just keep trying to improve my position in it? How do you approach that?
When I look at a stock, you want to decide whether you want to have cash flow or capital gain opportunity. I like both. There are a lot of times where I say, I think I can get a good cost basis on this, and I think this is a stock I could, sell covered calls on and, grow that over time and hold on to it. As long as I don't get called out, I'm fine. And if I do, I can hop back in. So there's some nuance to that. But I love to have a smaller amount of money and trade opportunistically. I also like to short the market.
Okay, so that's okay.
A great example of a stock I've been short, and I hate to throw these out because then people go out and copy it, and
Well, they're watching it. They're watching this at a different time than we're recording it. So yeah.
But I just got out of a short on GameStop, which was very, very profitable for us because GameStop fundamentally has struggled. They remind me of Blockbuster trying to compete with Netflix. The idea of going into a retail store with a downloadable digital thing, I think it's antiquated. And so that's not a cash flow deal, is it?
No.
And so we bought a bunch of put options on that, and took a bearish position, and got lucky. We get lucky once in a while. So if I see an opportunity like that, I'll throw some money at that for sure. Learning how to short might be one of the smartest things anyone, whether they're investing in real estate, business, stocks, or commodities, learning how to short can be a very intelligent thing. Because if I were to tell you to find, this is an interesting conversation actually. If I were to tell you to find Steve Jobs when he was small, how would you have done it? He's in a garage with Wozniak selling their calculator and their Volkswagen to build a circuit board. How many nerds were out there doing that? 1 billion? They just happen to be the two that made it. They're so small. And yet when you remember back when, who was running? It was Obama and Romney, and they were fighting over whether or not GM could go bankrupt. Here's this massive behemoth of a balance sheet for everyone to see, and it's clearly that bankruptcy is a possibility, if not a probability. You know how easy that is to see? And so going short lets us take something. It's often easy to see big problems than small startups, in reverse. The other reason I like short is for the real estate investors, a lot of them really don't understand this. It's not about real estate, it's about the dollar. If you look at gold, I don't know if gold's going up or down, long term. I don't know if Apple's going up or down. I have to watch that, month to month. But if you ask me where the US dollar is going to go in 30 years, it's a no-brainer in my opinion. Well, if you can borrow that when it's worth something, trade it for some real estate, and then give it to the bank slowly, back to the bank over 30 years, you're giving them back dollars that are worth less. Right, I probably said that too fast.
Yeah, worth less.
Worth less, right?
Yeah.
You're giving
or
them
worthless.
And
but you're giving to them with interest also.
Yeah, that's a shorting of the dollar. That's the way a guy like Warren Buffett would look at that. That real estate is a great way to short the US dollar. And so that's a foreign idea to most people. How in the world do we make money when things drop? Well, if you look on the horizon of some of the storm clouds that are out there, having that ability, if it does happen, to hop in there, oh my gosh, it can be the greatest opportunity you've ever had.
So that is actually fascinating, the perspective of shorting the dollar, right?
Yeah, for sure.
Because like when you're trading dollars for gold, you're shorting the dollar, right?
Yeah, anytime, there's 4 steps to short. You borrow something, trade it for something else, trade it back and return it.
Yeah.
That's it. And so even if you look at a financial statement and you track the money from the bank into the liability column for a loan, that's a borrow. From the bank loan into the asset column of the house, that's a trade. Then you trade it back in rent, and then you return it back in a payment. All 4 steps of shorting a dollar are there. 1, 2, 3, 4. If you learn how to short, It's fascinating stuff.
So if you're shorting the market, and like you're talking about like GM, like you're saying, hey, these
Yeah.
are big and they're obvious, but isn't everybody else shorting it also at that time, or there's people taking the other side of that?
You'd be surprised. There's a statistic called the short interest. You can find out how many shares are short. When a bank takes your money in a savings, they can loan it out. And a brokerage can loan out shares as well. So it's the same idea. Well, the bank can tell you how much money they've loaned out. The brokerage can tell you how many short shares they've loaned out. And you'll be surprised. Most people don't know how to short. It's risky because if you go long and a stock goes down, there's a limit to what you can lose. But if you go short, well, how high can it go? Infinity.
Right.
That's
Right.
theoretical, but it's still there.
Right.
And there's, dividend risk and other risks to learn about. But very few people know how to short. And if you look at a guy like George Soros, when the Japan came out and said, well, we're going to inflate the yen. We're going to go crazy and print money and print yen. And Soros says, great, I'll short it. And he made $1 billion in 1 year just watching the yen drop. So there are opportunities for real investors, high-level investors, short. We should not talk about this without underscoring the risks that's there. These are sophisticated, relative to the layperson, they're sophisticated. And they should not be attempted without proper knowledge.
So why didn't everybody else short the yen when they said we're going to start inflating our currency? I mean, wouldn't it be obvious that's what everybody should do?
It's interesting how many people really did. When you look at the Forex market, that's a market that's $4 trillion going through today. And for a buyer, there's a seller, right? All of those pairings have someone on the other side of it. So you'd be surprised how many people are short and do bet against things. And it also gets complex here, though, because let's say we feel the dollar's, maybe in trouble, but it might be how can I say this without having an edit? It's probably the least ugly girl in the beauty contest. Is that politically incorrect? Am I going to get hate mail on that?
I normally say it's the tallest pygmy.
Yeah, there you go, exactly. But when you look at the dollar, it's going to hold some strength for a little while because where else you want to put your money in the euro? You want to put it in the yen? Probably not. Considering the monetary policy. So,
how much of your own income would you say on average in a typical year for you comes from shorting versus the other vehicles?
Very little.
Oh, very little. Okay.
Yeah, it's opportunistic. You'll see something like a GameStop or see something like a short on the euro or something like that. You'll hop in, but very, very little.
Okay.
That's play money. That's fun money. However, we've been in a bull market, haven't we?
Yeah.
And it wouldn't make sense for me to be short on a lot of stuff, would it? Now, if you ask me that in 5 years, if we've had something drop, well, I might have a different answer at that point. One of the things that I lamented 10 years ago, is that I was not more aggressive in my shorts because we'd never seen anything like that before. And hopefully I'm 10 years old, I'm 10 years wiser, or 11 or however long it is now. And so ask me that in 10 years and we'll see what it is. But right now it wouldn't make sense. Now, I will say this, if you ask me what my income is in terms of selling options, when you're selling those short, and that's significant. That is an important part of what we do every single week.
So shorting, I think many people have heard the term, they kind of basic understanding of it. How can you really illustrate what's really going on when somebody is shorting a stock?
It's a great question because short positions are backwards in your mind, right? It's how in the world do I make money when something's going down? And it's a lot of fun. As I've traveled around the world, we've done this in many languages, and I found it really helps if we want to do a little lesson right here.
Let's do it.
To borrow something that's going down. So the first thing, we got to get an idea on direction.
Okay.
So let's get out of the stock market, out of the real estate market. Let's just choose an object that we think would depreciate. One of the ones I'll use often is a cell phone. Do you have one? Okay, so here it is.
Brand new.
So brand new. So that's the iPhone 11. Right, brand new as of this recording. And if you sell that on eBay, what do you think you go for today? Just maybe.
Well, it's a 512 Pro, so it was yesterday.
Yesterday, okay.
It was $1,400.
$1,400. Okay, so let's do this. So let's go 700 and 700, and that's $1,400. So that'll work out great. Now, if you look at last time we and I spoke, we said policy can tell us the future.
Right.
So what's Apple's policy on phones? How often they come out with a new one?
Every 2 years.
Every 2 years. So what do you think the chances are that they're going to come out with an iPhone 11 Plus, 11S, 12, whatever it is? What do you think the chances are?
100%.
100%.
Yep.
So when that happens, I'll draw a graph here that your 11, we'll just put I11 here, will go from $1,400 down to what the very day the new one comes out?
I'm going to say $400.
Okay, so let's go half.
Okay.
Okay, let's go seven. Let's go 700 because that way the math is easier for me.
Okay.
So now we have a vision of something that's going to go from 1,400 to 7. Now, whether it'll hit 7 or not, what % confidence do you have that it will go down?
100%.
So that puts us in a nice situation. What's interesting is if you look at a financial statement, there's a fascinating component to it. You have assets and liabilities. If something in your asset column goes up, what will happen to your net worth?
It increases.
It increases. But if something in your liability column goes down, what was your net worth do?
My net worth increases.
So that tells me there's 2 ways to get rich.
Yeah.
I can buy things that are going up in value, or I can borrow things that are going down in value. That's a huge epiphany for a lot of people. They've never
So
thought
you say
about
borrow
it.
them, we say you're borrowing them at a certain price, or you're borrowing them waiting them to go down?
Well,
and then-
let's give it a shot.
Okay.
Let's just see if it works.
Good.
It's kind of a mind blower, isn't it?
It is, good.
2 ways to get rich. And it's kind of nice because in order to buy an asset, what do you have to have?
An asset or
You
money.
have money.
Yeah.
But in order to borrow money, well, you just say, can I borrow something? So let me give this a shot. Can I borrow your phone for a minute?
Yeah.
Okay, so I borrow your phone. So here we go. I borrow this phone, and now that I've borrowed it, I can do anything I want with it. Now, you still own it, but I possess it. And think about this. When you borrow money from a bank, what do you do with the money?
Whatever I want.
Yeah, you do whatever you want. Is it your money?
Yeah.
It's
No,
the bank's money.
It's
You
bank's
borrow
money.
the
Yeah.
bank money, but you can do whatever you want with
Right.
it. Well, it's the same thing here. I can do whatever I want with this phone. So you know what I'm going to do? I'm going to sell it on eBay over here. And I'm going to get $1,400 for it right there.
Okay.
So I just went from 0 to 1,400, right? So now I wait, and I wait, and the iPhone, 12, 13 comes out, and down it goes. So now it's down at our $700 price. So what should I do? Well, I'll buy it back, and now I have $700 in the phone. And my final thing is to return to you your phone. Now I don't owe you anything, and I'm left with $700 because I borrowed something that went down in value. Now, that's a wonderful example that people can practice and play with. And
But why
learn
would I
from.
lend this to you in the first place?
Because I asked you to. No, let's say my interest on it is 2%. That's fine.
Okay.
I'm making plenty,
Okay.
right?
So I'm
works.
basically lending it to you to get interest back on
Yeah.
the asset.
Yeah, and that's exactly what they do with the dollar, isn't it? And that's why real estate is about shorting the dollar. If it falls faster than that interest rate, and it's important you mention that, because why do you think they amortize? If they didn't, they'd get killed. They have to get all that up front.
Right.
Because if they waited 30 years, they'd be getting dollars back that aren't really that valuable, are they?
Right.
Learning how to borrow something that's going down in value and do it with intelligence opens up a whole new world for people, a whole new view of your financial statement. Buy things that are going up in value, borrow things that are going down in value. Actually easier to borrow things than to buy things, actually.
Fascinating.
Yeah,
Well, I guess after all these years, in summary here, because you've been doing this for a while now,
long time.
some decades, and not only are you doing it yourself, but you seem to have a lot of passion about teaching it.
Yeah.
Does it stay interesting to you, or are you bored?
I'm absolutely fascinated because I learn more every year. When people say, Andy, I'd like to be one of your students, I say, well, great, we're students together.
Yeah.
The moment I think a person takes the position that they know something, they stop learning. It's a dangerous context to have. So I consider myself, you, all my mentors, we're fellow students, learning every single year. If I got in an investing contest with Warren Buffett, I'd probably lose. He's a lot smarter than I am. But all of us have equal but different talents. So the thing that keeps me teaching is a person wants to feel like, some people have jobs, some people have careers, some people have callings. And a calling is when you're doing something that you're good at, that is, you feel is for the greater good. That never gets boring for me.
Yeah.
And if I'm limited in my talents, which are really, I can change a light bulb, put a star on a Christmas tree, but I can also teach people how to short and trade options. That third one, that ability to simplify, has been a joy for me to help people with, to take things that are really complex on CNBC, boil it down to an example with a cell phone.
That's awesome.
Yeah, a lot of fun.
Well, Andy, as always, thanks so much for coming here and sharing all the wisdom and excitement about all this stuff. It's been really fun.
I have been so impressed with Money Revealed. As I watch those interviews and the people you've brought together, it's a project that's unique in its kind. And I gained a lot of value as a student watching all of those great mentors of mine. So thank you for having me, and thank you for the good you're doing.
Thanks so much.
Awesome.
We are over the moon excited about the feedback we're getting from the Wealth Breakthrough series. And I want to give a very sincere and special thank you for those who bought the series. It supports us, supports our work, allows us to get this out to the world for free so people everywhere can have their wealth breakthrough. But for those who bought the series, it's especially heartening to us to be able to know that you're supporting this work so we can do what we do every single day. Andy Tanner just showed you portfolio construction tactics that can pay you safe dividends for life. Now, let's look at the other side. How another master of wealth who hasn't touched a stock in years uses a unique niche of the market to bag big gain after big gain. I'm talking about an often misunderstood way you can turn 10% stock moves into gains of 100%, 200%, or more. Alan Knuckman is one of the most successful option experts in America today, and he's got a heck of a story to prove to you why right now is the greatest time in history to trade the markets. Here's Alan.
Alan, thanks for taking the time to have this
Thank you.
conversation. So tell us about your background. How did you get to be doing what you're doing?
Well, I started the exchange way back when. I've been doing this for almost 30 years now. Working on the trading floor, worked with guys that had Ivy League degrees, guys that didn't even finish high school. So you had to learn by doing back then. Down on the trading floor, it was quite the boys' club.
Which trading floor were you working on?
I was in Chicago at the Chicago Board of Trade. So I was down on the grain floor, and you start as a runner, which is not very glamorous after getting out of college, and you're essentially picking up trade tickets off the floor and bringing them back to the desk. So it's picking garbage, but you have to be able to pick the right garbage so the team in the desk that you're on and bring those orders back. But that really gives you the background and the understanding of the whole cycle of the trade, from the customer to the desk to the actual pit to back to the customer. So you get a feel for how the markets really work, as opposed to now, I think people don't appreciate by just clicking on a screen, when they buy or sell something, really what's behind it and really the supply and demand dynamics.
Can you walk us through that then, the actual cycle?
Oh yeah, so it's a very simple process, but it's happened for 150 years. There's still some open outcry markets right now, but very few. A customer would call in with a trade. They want to buy some corn contracts or whatever it may be, and that was in the futures market, obviously. So they would call their broker. The broker would call a desk on the trading floor. The guy on the trading floor would write down the ticket, buy so much corn for which month and for which customer number, hand it to a runner. The runner would take it into the pit. The broker would fill the order if the market's right there, and then they would drop the order ticket on the floor. Another runner would come by, pick up the ticket, bring it back to the desk. The desk would call the broker, and the broker would call the customer.
Wow.
Now that would all happen within a couple of minutes, so it was very efficient. And we're talking about hundreds of millions of transactions that happen that way. Very efficient, very fluid, and obviously everything has changed with the electronic markets. But what that has done is given so many more opportunities for everybody. Whereas it was an old boys club, now with electronic markets, anybody can trade any market, any direction, any time, so there's always opportunity.
So those scenes where you see, like on the old scenes from trading floors and pits, like
Right.
people are screaming, yelling, it looks like mass chaos. That's the
That's
environment
it.
you were in. when
Right,
you
but
started out.
everybody, it's actually very organized. It doesn't look like it, but every movement, every sound, every hand gesture means something, and it's very efficient. And that's how it was done for 150 years. And it's amazing how much money was transacted on a daily basis, but that's just the way it was. Now, some of those things are gone, and working on the trading floor, I think I got to appreciate some of the money flows and the way the markets would react, and noise and quietness and fear, and you get some clues that you don't get when you're just staring at a one-dimensional screen.
Yeah, because there's all these dynamics going on
Right.
that you're just basically oblivious to, I guess.
Right.
So you started as a runner. What ended up happening from there?
Well, everybody starts at the bottom, and made $2.35 an hour. Was real rich, and then eventually you move up to be a phone clerk, and then you end up being an assistant trader, and then if you can get someone to back you, or you can get some money, you can trade for yourself. So that's the path, and everybody wants to go down that route and give it a try. I mean, it's capitalism at its finest. If you can make the markets work for you as a trader, there's nothing better in America. It's simply supply demand. It's simply you in the markets. You kill it, you eat it. So that's the beauty. It's like I said, it's pure capitalism. But the problem is, 9.5 out of 10 guys blow up. They lose all their money. Is how it works. So it's quite an environment. But for most people, it's worth taking a swing at, because if you can make it work, it's the best vocation, I guess. You don't have employees necessarily. I mean, you might have assistants, but you don't have a store. You don't have certain hours. You don't have inventory. You don't have all these other variables to deal with. It's pure capitalism.
Back when you started, it was getting your foot in the door. It sounds like you said, it's like kind of a very closed club. You got to get in. So so the big, I guess, breakthrough is trying to get through that door and starting as a runner and working your way up. Nowadays, pretty much anybody can enter the market, right?
Now there are no barriers to trading. There are no barriers. And, with commissions essentially free, that's actually a bad thing in my opinion, because people aren't as disciplined and they don't plan their trades as well as they need to, because, they can be emotional and get in and out. I think commission actually performs a function by making you think through a trade. But to get back to the barriers to entry, it was kind of who you knew. My hiring is very unique in the fact that I was in the viewing gallery one day, and somebody on the trading floor saw me and sent his assistant up and asked me if I wanted a job. And I was like, sure, and started and worked from there. Years later, I found out it was because I was tall, not because I'm smart. So, I like to think otherwise, but being tall was an advantage, because I'm 6'2", so people can see you in the pit, and that's visibility is a key.
Wow, that's interesting. Yeah, you're not tall on a screen when you're trading online, right?
Exactly. It doesn't matter how tall you are.
That's right.
If you're sitting on your wallet, you can be tall.
So there's different kinds of trading, I guess. I mean, if we're looking at day trading, or maybe maybe longer term time horizons, what have you. Can you describe the different forms of trading as you see it now?
Well, first, I like to use the words trading and investing interchangeably. People have a negative connotation with the word trading. Trading is not negative. Trading is someone that has a plan. They know where they want to get in. They know where they want to get out, if it goes for them and if it goes against them. So they're in it for a long series of high probability positions. An investor doesn't really have a plan. Investor buys or sells something, and they say they'll get out when it goes up or down. Okay, they don't really have a plan. So a trader is actually a more sophisticated investor. So I think being a trader obviously is a positive if you can look at it in those terms. So going down that path, I think it doesn't matter what you trade or how you trade. You have to have a discipline. You have to have a plan, and the key is about putting risk reward on your side. And my big breakthrough, I thought years ago, was when I ventured in the options space. So options are really just a better way to trade.
Why?
A smart trader can take advantage of so many variables when it comes to options. When you're buying or selling a stock, it's binary. It either goes up or down, right? You've got a 50-50 chance. With options, there are so many pieces of the option. I make it very simple. I'm not trying to be the smart options guy. I'm just using options as a vehicle, but I can control my probability. I can decide that I only want to put on positions that have a 70-75% chance of being successful. I can control time. I can control volatility. There's so many different things that are beneficial. There's always a better way to trade using options than just strictly buying or selling the stock.
With that being true, why isn't everybody doing options? Like, what keeps people into trading,
That amazes me. That completely amazes me. And when you turn on that light bulb for people, they completely get it. And they're like, I can't believe I've been trading stocks here in the past. And there's always a better way, and just a basic stock substitution strategy where you're buying an in-the-money call that's going to behave like the stock. You have less money tied up, you got limited risk, you've got some staying power to ride through the ups and downs, and most importantly, you've got a significantly greater payout because of the leverage with your option when you're right, when it moves in your favor. So it's going to act like the stock. So if nothing happens, it's not detrimental to you. But if there's a small, modest move in the underlying stock, a 5% move, that option could gain 50%. If there's a 10% move in the stock, that option would gain 100%. So it's all about math. And I think once people look at it and overcome their anxieties and fears about options, I think the light bulb's on and they'll never go back to stocks.
If I open up a brokerage account, let's say with the E-Trade or Ameritrade, what have you, and I start to just trade equities, not options, who am I competing against?
You're competing against everybody. I know a lot of people get overly, I guess, concerned about the high-frequency traders. They really have a limited impact on the market. They're trying to make parts of a penny, so they're providing a little liquidity. I'm not worried about those guys. And the way I trade, I'm not a short-term trader. I used to be when I was younger. That's not as much fun as you think it is. It's not as glamorous as you think it is, being chained to your computer, and any burp or blip in the market is a deal that you have to handle. I use options to trade longer term. I'm looking usually 3 to 6 months out, if not longer than that, so I can ride through the ups and downs. I can look at markets more on a weekly basis. I call them lifestyle options. They fit my lifestyle. So I don't have to sit there in front of the computer all day, but I'm still taking advantage of great opportunities in the market. And I can't say it enough. This is the best time in history. Let me say that again. The best time in history to trade the markets. There's always opportunity. When I was a young kid, whatever pit you were in, if there wasn't something happening that day, you could force a trade, end up losing money, or you could keep your hands down, or you could go home. So any day there's always opportunity. So things are so much different than they used to be. I'm always optimistic that there's opportunity. It's just my job to sort it out and take advantage of it.
If I decide to become an options trader, as you're suggesting or recommending.
When
I decide to become. Okay, very good. Who am I competing with now? Is it a different group of people, and is it a different dynamic in that competitive pool?
Well, somewhat. It depends on what type of trading you're doing. But some of the best minds in the markets use options because they're so much better vehicles. So if you're a smart guy, if you're Goldman Sachs or Morgan Stanley, and you have a strong opinion of what you think is going to happen, you're going to use the options market. It's going to give you the best payoff. And then it's going to give you limited risk. You're going to get better use of your capital. So that's where they're going to load up if they've got a very strong opinion on something a stock's going to do. So you're in the same marketplace with those guys, but then there are also novice options traders. And the reason that options get a bad name, so to speak, for some people is because they've learned the hard way. They buy too little time, and their strike prices are too far out of the money, meaning that they're really just long shot options. So even if the market moves their way, they've got those variables working against them. So once you understand those components and factor them out of the equation, like I do, buying enough time and in the money options and so forth, try and make it very easy, using options as the vehicle. Once you eliminate that, then it's off to the races. So it's really just about the math. But the beauty of the options market, it's very transparent that every trade that every person makes is seen on the screen. So if somebody is loading up in some company, that's going to be visible, and you're going to be able to see that. It's very transparent, and it's got very tight liquidity now, as opposed to years ago. Now we have pennies spreads, meaning the difference between where we're going to buy and where you want to sell. Whereas in the past it used to be 20 or 30 cents. So that's really made execution of your trading plan very, very smooth.
So I've got a college senior graduating with a economics and finance degree, figuring out what he wants to do. And so now I should say to him, like, if this was your son, would you be giving him, or anybody that's watching right now, it's the reason I'm asking the question, advice saying, I think if you want to move into the area, of stocks or options, what have you, that options is really the thing to master, the thing to learn, and that it's a sustainable way to develop wealth over time. Is that the way you see it?
Oh, absolutely. There's really no reason to trade an individual stock. You may want to hold it to get dividends, but that's really the only example. You're going to be much better off with an options play or an options strategy based on whether you think the market's going up, down, sideways, where you think the market's going to go, where it's not going to go, what's going to happen as far as the time component, increase or decrease in volatility. There's so many variables you can take advantage of. So it's definitely the route to go. Now, to get back to the economics degree, when I went to college, there were no classes on trading. You just had to learn by doing it. And, like I said, I'm going on my 30th year of this. So I've seen it all and I've done it all. But the one thing I want to stress is be optimistic. Be optimistic of the opportunity. There's always money to be made. Markets aren't good or bad. They go up, they go down. But the more the markets move, I always say volatility is opportunity, because the more the markets move, it's our job to take that piece out of it.
So let's maybe get granular now. Walk me through an options trade. What is actually happening? How do you go in it? How do you come out of it? What are the upsides? What are the risks?
Well, if you're simply buying options, which is what I recommend, it's limited risk. The maximum exposure you have is what you pay in premium.
Explain what an option is. What is that literally?
So an option controls 100 shares of a stock. So if you wanted to trade Coca-Cola, you're controlling 100 shares of that underlying stock, and you're paying a premium for that. You're paying a certain amount. And then to unwind it, you sell that option. So depending on your strategy, depending on your outlook, where you think the market's going to go and over what period of time, that will help you determine what strike, which month, and all these other variables. But I try and make it super, super simple. If I think the market's going up, I'm buying a call. If I think the market's going down, I buy a put. And
so imagine that I don't know what a call or a put is. So explain what those things are. So let's say that, let's do like a use case here.
Okay.
So here I am, I've opened up my account. Now you've got me convinced I should be doing options. I'm a fool if I'm going to just buy stock and trade.
All right. Well,
stock.
tell me the stock. Tell me a stock that you
So
like.
let's say Amazon. Let's say
Okay.
I like Amazon. I think it's going to move up, not down, and so I want to buy options on it. So what's my process?
Well, Amazon's going to be difficult because it's such an expensive stock. So the options are going to be more expensive as
So
well.
give me a stock that I should be looking at.
So
like-
let's look at something like, let's say Intel.
Okay.
Intel trading around 60 or so.
Okay.
So you could buy a 55 call for, let's say, June.
I don't know what a 55 call is.
Okay, 55 gives you the right to be long from 55. If the market's trading at 57, that's at a discount to where it's actually trading at now. So you have the right to be long from that price. You're not going to exercise that. You're buying the option, and then you're looking to sell the option. If the market moves up, it's going to increase in value, obviously. So it's very straightforward. But the idea here is because you're controlling that 100 shares, I think that's the point I want to get across and not get too much into the logistics of this, is you're controlling 100 shares of the stock. If something's trading at, what do we say, 57. So 100 times 57 is $5,700 is the value of that option. Now, if you want to buy the stock, it's $5,700. The option might only cost $400 or $500. So for 1/10 of your investment, you're getting the same control. So some people look at it, they don't understand the positivity of the leverage, because you have that $400 or $500 you're paying for that option. That's your maximum risk.
I was just about to ask, is that the maximum risk?
That's your maximum risk, no matter where Intel goes. If Intel goes to 20, the worst thing that can happen is your option expires worthless. You're out that $400 or $500. You can put a stop loss in it just like you can on a stock. But I think as a vehicle, it's important for people to understand that capital outlay is usually 1/10 of what it would take to buy or sell the shares of stock. And that's huge, because you're getting much better use for your money. And with the June option, in this example, we're looking at about 5 months out or whatever. That's some time for some development. I'm not planning to be in it that long necessarily, but I have that time, so I don't have to worry about that component being an issue. That's one thing at the exchange. The guys on the trading floor at the any options exchange, the guys on the floor made their money over the past years by selling these out-of-the-money, what we call lottery tickets, to novice traders. A novice trader comes in and says, listen, I think that Intel's going to go up. I want the Intel $70 call because it's trading at $25. The reason it's cheap is because the mathematic probability of that being in the money at expiration is almost zero. But if those guys sell those options every single month, sell those front month, what we call lottery tickets, they're collecting that money, and unless there's a huge move in that stock, they keep that money from the novice traders. So they do that month in, month out. That's why those guys have the best houses, the best cars, the best lives, by taking advantage of that time decay and the people that don't understand the basics of options.
So there definitely are predators out there taking
Market
advantage.
makers.
Oh, is that what they're called?
Market makers. There are people that are making a market, and if you can buy and sell anything you want. They're not telling you what to buy, but they just, if those people don't understand the odds.
Right. But they're predators in the sense of they're saying, hey, you're ignorant. I'm going to sell you something that has a very low probability of succeeding.
Well, I mean, wouldn't anybody want to do that?
Yeah,
I mean,
course.
that's a perfect business.
And that's why I guess ignorance is a problem. So I guess information and current information and learning, I mean, these are important aspects. You don't just show up one day and say, hey, I think I'll do this. You need some guidance. Would you agree with that?
Right, yeah. And like I said, I try and make it as simple as possible. And my stock substitution strategy is what I do 95% of the time, where I'm just buying a call or a put that's in the money that's going to act like the stock. So I'm using all the positives of options, but I'm getting the benefits of the underlying stock move, if I can anticipate direction, which I have a pretty good handle on. And then you're going to get a much better payoff with an option than you would the stock.
Can you do options also on indices, or is it just stocks?
Yeah, you can do options on almost anything. Options on futures, options on stocks, options on indexes. So options are just a tool. And for a lot of people, they seem intimidating, but they shouldn't be. Once you get into that first trade and understand the basics, like I said, that light goes on, you get it, and you're like, dang, I shouldn't have been in stocks all these years. This is such a much better way to trade.
Do you trade any stocks anymore, or when's the last time you have?
No, I can't even think of. Like I said, unless you're trying to get in, you just put in a stock in a brokerage account to get the dividend or something. I don't see why you would even want to do that. There's a much better way to do it. Now, some stocks when they first come available aren't optionable right away. If you're talking about something that just IPOs and stuff like that, it takes a couple of weeks for the exchange to get the options up and running. But the answer for me is no. I don't see any reason to trade a stock.
Do you have a preferred place where you trade as far as which floor you might trade on?
No, I don't try and predetermine wherever the opportunity is. And now with technology, your orders just automatically go to where you can get the best price. Now, I think there's 16 maybe options exchanges. So years ago, before the markets got efficient, is a polite way to put it, the brokerages would route orders to where they wanted, so you weren't always getting the best price. And for a while, we could take advantage of that because you could buy in one exchange and sell on the other exchange. But now the markets are so liquid, and that's such an important attribute right now, that there's so many buyers, there's so many sellers, that the spreads are so tight. With no commissions and tight spreads, you can execute your trading plan. So that's why it's important to be a trader and have that plan. You know where you want to get in. Like I said, if you buy a $500 option and you put in a stop loss at $250 because you don't want to, risk the whole thing, it's a lot better to get out. You can always get back in than, trading on hope, because hope is not a trading strategy, hoping that it comes back.
Right. You say there's zero commission. I mean, is that actual? I mean, it's a low commission.
Well, I mean, a lot of the brokerage firms have zeroed out their commissions for stocks, but for options, I think it's 65 cents. So essentially, it's zero. And like I said before, if you're worrying about commissions, you're focused in the wrong place. The reality is, commissions make you think about your trading strategies. This is not gambling. This is probability. This is a long string of high probability positions. So over the long run, you're going to come out ahead. It's not about today. It's about next week, next month, next year. It's doing this on a consistent basis, and using the right option strategy, I think, allows people to do that because it's more lifestyle friendly instead of worrying about the market's ups and downs. And we've had amazing ups and downs, but I again come back to the optimism. We've overcome each and every crisis over the last decade that should be head spinning if you reviewed it. I mean, Brexit, impeachment, trade wars, viruses, that's just in the last months, okay?
Right.
Any one of those in the past would have been, a market stopper. But I think people have to be conditioned to the continued opportunity in the marketplace. And I know there are guys that you interviewed that say the end is near. But, where has that gotten them in the last 10 years?
No kidding. I mean, you can keep predicting it, but it's as you said. I mean, it's almost like the market's starting to say, you guys just go and have your little hissy fits over here.
Right.
We know what's really going on as far as wealth in this world.
Right, and it comes down to, again, the supply and demand. There's only so much, so many public companies, and it's about money flow. Money's chasing yield, and the yield has been in the stock market for the past decade or more, and with interest rates continuing to go lower, there's not really any choice. Until there's a choice, until short-term interest rates are at 4 or 5%, and people have a choice between putting their money in treasuries or putting them in stocks, people are going to continue to put it in the stock market. Yeah, there will be ups and downs and bumps, but I think the overall trajectory, people are conditioned to take in a certain amount of their paycheck, put it in their 401k, a certain amount into the markets each and every month. And I don't know what's going to change that. Maybe someday that'll happen, and we'll know that. We'll be able to take advantage of it. I don't care. I mean, I do care if the markets continue to go up. I want them to go up, but I don't care if markets go up or down. I just want to make money, and there's always going to be money to be made.
It's interesting. I think you just made a point that kind of struck me, is that there's a limited amount of stock or companies that are out there.
Right.
And it seems like there's more and more capital coming to invest somewhere. And when that's happening, what can it do but drive the market
Well,
up?
there you go. See, the economics degree is coming through now. It's supply and demand. So you can see that if there's money, chasing a finite amount of assets, actually there's been less and less stocks on the exchanges over the last years as fewer and fewer companies, come public, and there's been mergers and acquisitions and so forth. So there's, the money flow. The money has to go somewhere. Yeah. And the question is, two big choices: stocks or bonds. And I don't think that that the smart money is going to go into the bond market to get 1.5% yield.
No kidding. So when you look into the future, and I imagine you do that, and you see what you think is going on. So obviously you're very bullish. You think that, hey, this trend is great. It's going to continue. The sky's not falling. It seems to be your perspective. Would that be accurate?
Yeah, but I've been bullish for, I would say, almost 10 years. So, and I'm a very technical trader, and for me, it's important to see how the markets act, and then more importantly than that is how they react. And each and every time we've had a sell-off, a pullback, the markets have responded and made new all-time highs. And actually, if you look at it, every time there's been a drop, if we go back to December of 2018, when we had the trade war concerns and the stock market sold off 10%, you take the distance of that drop on those old highs, and that's a full V recovery. It's achieved new all-time highs each and every time in market history until it doesn't. But you just use that very simple technique, and we still have more upside from that last sell-off in the S&P. So let's see, once we achieve that, where we are. I'm not saying it's going to be a straight-up move. I'm not just blindly bullish. I just like the market action. I like the fundamentals. And if we get into what the stock market really is, the stock market is a valuation on future revenues, okay? Who's making money? Corporations are making a lot of money. So, until that changes, the stock market's still the place to be.
So let's say, okay, now I'm watching this. You got me convinced. Options. All these years I've been in stocks, and options sounds like the right thing to do if I want to, start trading. But maybe there's some people who shouldn't be doing this also. So can you give the profile of maybe the person who should maybe enter options trading and the person who should maybe steer away from it?
Well, it depends on how soon you need your money. If you're close to retirement or something like that, I'm not a financial advisor from that standpoint. That's a different game. Now, if you're trading the markets, I don't think it matters who you are. If you're actually trading the markets, this is a better way to trade. Like I said, you've got higher probability, you've got lower risk, you've got lower capital outlay, and you're able to have some staying power when you can buy some time to ride the ups and downs of the market. So I wouldn't say to eliminate anybody when it comes to options. If you're a trader and you have that mentality, that I cannot think of any reason not to. But it doesn't matter what the vehicle is. It doesn't matter what you trade. If you don't have discipline and you don't follow your trading plan, you're not going to be successful. I don't care if it's trading penny stocks or mutual funds or buying gold coins. If you don't have a plan and you're getting very emotional about what's going on, that's where people get themselves into trouble. And I think that's one advantage I have over a lot of other people, is that I understand the psychology of the markets. And I have a good feel for how people's behavior is impacting what the markets are doing. And the fact that more and more people are as optimistic as I am, that has raised a little bit of a red flag for me because I kind of have more of an opposite viewpoint a lot of times, and I understand how the markets work and how people behave and how I can take advantage of that because they get they're oftentimes selling when they should be buying and buying when they should be selling. In the last few months, I've been unloading a lot of positions. And selling too soon is what I always tell people, is I'm accused of, and I do it all the time, I sell way too soon. But so what? Still made money. That's why we do this. You can always get back in, there's more opportunities, there's something else, but sell too soon is a mantra that I often get accused of.
What's the learning curve? So let's say, okay, at least I've got some experience, trading stocks, but now you got me convinced again, options I really should be looking at. What's my learning curve to get into this type of a...
Oh, the stock substitution strategy, just a couple of weeks you'll be up and running and get it. So
Wow.
It's very straightforward. So instead of buying or selling a stock, you're just buying a call or buying a put. It's straightforward, it's simple, and buy in at least 3 months' time, and it's just math. And I'm not trying to be the number cruncher guy because the markets are now so efficient that if something theoretically was undervalued or overvalued, that's how guys used to make their money in the options market. That doesn't happen anymore. The markets are completely efficient and everything's fairly priced. And so that's not my game. My game is just trying to be ridiculously simple. And I've got options friends that are like number cruncher option geeks, and they don't consider me an options trader. They just consider me a trader, but I use options as my vehicle because it has so many advantages.
That's an interesting distinction, actually. Saying, hey, there's...
I think they're doing it in kind of a slight way. They're saying that I'm not as smart as they are, but I let the success make up for that.
How smart you are is reflected in the numbers.
That's what I say, exactly. Look at the results. It's all about results.
So they're just trying to make themselves feel better then.
Right, but they had the right number on a piece of paper, but that number on a piece of paper doesn't necessarily make you money. So it's all about making money. I don't care how I get there, using the markets legitimately.
So looking into how somebody needs, information flow. I mean, I know that you write on this and that you kind of talk about options trading publicly and you have a following around this. So is ongoing information important? Because you said you're a technical trader, so
right.
you're looking at technical things. But is there general market information that informs me if I'm options trading?
The first thing I'll tell you is turn off your TV.
Wow,
all right, turn off your TV. Do not watch it. I'm on TV.
No CNBC.
I'm on TV at least twice a day. All right, so Bloomberg, Fox News, CNBC. I'm on at least twice a day. But don't listen to anything that people say because there are very few guys on TV or women. Anybody that's going to go on TV and here tell you anything that's going to help you make money. A lot of it is just mental minutia. They're just talking to hear themselves talk. They're not going to give you anything specific to help you make money. They're not going to say where to buy, where to sell, what to risk. They're not, and a lot of times they're fighting the last battle. They're talking about something that's already happened, and they're maybe fearful of something up ahead. So turn that off because all that does is affect your psychological approach to the markets. So trading is not exciting. Trading is not fun, even though making money is fun, but trading's not fun. Right. It should be a very mechanical process. You identify the opportunities, you execute with your trading plan, you manage your trade, and then you maximize the market move. That's it. It's making sausage. All I'm doing is I'm in a different market. I'm just I got a little machine and I'm just cranking it out. The process. I'm not trying to be the smart guy. It's not about my opinion. It's really just about facts and numbers. And like I said, turn the TV off because a lot of times that just causes confusion. And if you notice, they're in the business of getting you emotional. All right.
Oh, yeah.
They want you to stay watching their channel. They want you to be glued to your seat. They want you not to be able to turn off because the next number is going to be the next greatest thing that's ever going to, impact your portfolio. And they're always thinking short term. I'm thinking, 6 months, 9 months, a year out is where my head is. I'm always trying to do this like chess with 2 moves away, whereas they've got you focused on the near term so they can sell ads. Understand the business that they're in. They're selling advertising. They're infotainment. They're not there to help you make money. They're there to sell ads.
So tell me how you identify opportunities. What are you looking for?
Well, I just look at a lot of charts and I pay attention to a lot of markets and I've got a pretty good handle. I started in the commodities markets, like I said long ago, and it really all comes back to commodities. So if you can get a good handle on what's happening with interest rates, what's happening with gold, with oil, with some of these physical commodities, they're kind of the building blocks for everything. So as they move, that's going to impact stock. A bank stock, you're not going to trade a bank stock unless you have a handle of what's going on with interest rates, right? So, everything's all tied together. So I think I've got a good handle on how the supply and demand of the underlying commodities has an impact on the stocks and how stocks react. But I think more importantly, I've got a great handle on market psychology. I've been through this a lot, all right? I get a certain sense when there's not enough fear or when there's too much fear in the marketplace. And like I said, that's opportunity. And for me, when I feel that way, I'm not saying that I'm Nostradamus. I'm saying that when I feel that way, that I can put down an options position that has a great risk reward. So when sometimes things look the worst, that may be the best time to be the buyer of that, because at that point, what's happened psychologically is you've read and seen so much negative news about this stock and this company, and everybody's fully aware of that, and that's driven that stock or that company way down. And at some point, it runs out of bad news. So it's so bad, it has to be a buy. And then if you can buy a 6-month or a 9-month or a 1-year option on it, then you can be in position for when that fear alleviates. And a lot of times you're going to see a little bit of a rubber band snap back when people realize it's not as bad as what people thought it was.
So when you are making more money and you're accumulating more liquidity or more cash, are you investing also outside of that, or do you just say, you know what, as I have more cash as a basis, I just buy more options? Or do you actually put, for your own personal wealth accumulation, do you put money to work outside of trading options?
Oh yeah, I put money to work outside, definitely. And one funny thing was I was on Fox Business one day, and this was a couple years ago, and this was in the real estate market was having a tough time, and I was on with a real estate expert, and they wanted our opinions where to put our money now. My idea, and I acted on it, was I bought a beach house. And his idea, even though he's a real estate guy, was to go into the stock market. So it was about the timing of the opportunities when they're there. That was after the market had an extended run. Obviously, there's always more upside, but the risk reward may not be as significant or might not be to my liking. So then, no, I'm open to any and all opportunities. But I will say for novice traders or new options traders, learn to trade one option. Let's just say 2 options at a time. Okay. Start with 1 option. People think you got to trade 10 options or 20 options or 30 options, okay? So learn to trade 1 or 2 options. Learn the process, learn how to get in, learn how to get out, learn to make money, learn to take a loss. Learn that process, and you can always become a bigger and better trader, okay? Don't start at 10 or 20 options, because if you have a couple losses, then you're psychologically gonna, be in a tailspin, and then it's harder to make back your money when you're trading less options. So start small, become a bigger trader, and I always trade in pairs, because that way it gives me flexibility. Like I said, I sell too soon, so I'll take off half of my position if I can get to 50%, and then I'll keep the other half in if you can get up to 100%. Now, you're looking at me like 50 and 100%. That's pretty significant. Well, with options, you can get these big moves with a small move in the underlying stock. So like that Coca-Cola example or the Intel example, if the stock just moves 5%, that option can gain 50%. So it's all about the math. I'm not trying to say I pick the bottom and sell the top, but it's all about math, and you get these exponential gains just because of the math of the right option.
And so when you're winning, you like to just take chips off the table rather than let them keep riding.
Yeah. That's not something I'm good at. I hate gambling, to be honest with you. I mean, people go to casinos or go to Las Vegas for fun, but I don't think it's fun at all. I mean, it's not fun because, the odds are not on your side. It's gambling, right? That's gambling. If I want to be in a position where I can put odds in my favor, where I can control my risk, where I can, have a significant payoff when I'm right. This is not gambling. This is probability, and I can't stress that enough.
Here's something I find puzzling. There's a lot of these people who pontificate about the markets and stock on TV.
And I do too.
Yeah. Okay. And you do that also. But I'm seeing a lot of these people who are on TV, saying these things to the masses who have horrible track records as far as calling stuff. So how do they sustain?
Ideology. People will subscribe to a certain ideology. The markets don't care what your personal beliefs are. The markets don't care if you're Republican or Democrat.
Right.
The markets are the markets, all right? That's what we're there to take advantage of and make money from. But there are many guys that I work with that go on the air repeatedly, and they are completely wrong. But people have the same ideology as they do and the same beliefs, so they'll stick with them thinking eventually they're going to be right. So you have to think to yourself, do you want to be right from a political or ideological standpoint, or do you want to be right making money? For me, it's making money.
Right.
I don't, the market doesn't care what my personal beliefs are.
That's for sure. So this theme of this series is wealth breakthroughs. So is there an inflection point or maybe a number of things that you can point to for yourself personally that were wealth breakthroughs for you?
I think for me, once I realized that there are so many opportunities, that I don't have to be as laser focused, and I can't worry about missing that one event. You have to think big picture. And nowadays, each and every day, I can't say enough, these are the best times in history with these market moves. I mean, look what's happened with technology stocks. Look what's, even if there is a sell-off, there's ways to make money, and usually very quickly on market declines. So the money movement that we see now is so much different than when I was younger, and I think that's the breakthrough, is that there's always opportunity. I used to get very upset when I lost money, and I still don't like to lose money. Right. But my wife would ask me if I left an instrument in a patient or anybody died today, and I had to think to myself that it's just money. I can always make more. It's about having a discipline to attack the opportunity each and every day. I think that's the big breakthrough.
After your decades of success, you
2.9 decades.
2.9 decades.
It's not quite 30 years yet.
So, but you've accumulated a significant amount of wealth for yourself. It doesn't seem like you need to do this anymore. Are you changing your ways at all, or are you still?
Well, my lifestyle has changed in the fact that that's why I ventured in options, so that I can do what I want to do, so I can live the life that I want to live and not be chained to the markets, or just imagine being in a trading pit all day, every day, yelling and sweating on somebody else. That doesn't sound like fun to me anymore.
Doesn't sound like fun to you?
So this is the key: is the freedom to do what you want when you want.
Right.
But you still don't want to leave the markets alone. It's a great time. It's a great time right now.
That's terrific. Alan, I really appreciate you taking the time to share all this with us. Really informative and entertaining. I love your energy, so thank you.
Thanks a lot.
Taxes. Just saying the word can send chills down your spine. Tom Wheelwright's the tax expert's tax expert. He's a best-selling author and CPA and has one core message to share with you. Lowering the taxes you pay is the quickest way to immediately boost the amount of money you take home. Plus, almost every American makes these common tax mistakes that could be costing you thousands. But in this interview, he goes over simple, effective ways to quickly and legally cut your taxes by 20%, even 25% or more. Keep more of what you make. Get a tax strategy in place that works for your family. It's one of the easiest wealth breakthroughs that you'll ever find. Let's get started.
Tom, thank you for being here.
Thanks for having me.
Yeah, this is you. I've actually wanted to interview you for about a year. You were recommended to us a year ago. We were asking tax questions to Robert Kiyosaki, and finally he goes, "You just need to talk to my tax guy." And I think he mentioned your book that they published, and so I ordered the book, literally sitting there. Usually my partner does the interviews and I'm sitting behind the camera, and I ordered the book on Amazon, and I still haven't read it. My household manager, as soon as it came in, she got it and she started working on it and took this book of yours and educated her CPA with it, and literally
awesome.
as recent as last week, she was still making changes on her taxes. Actually went back, I think, like 5 or 6 years, and took some losses on a business that she had that she didn't know she could take, and redid her taxes based on your book. So the fact that I haven't been able to access your book, not like there's only one copy in the world, maybe I should just go ahead and buy my second copy, but do know that book did come into to great use and
Nice.
is turned into money. So I'm excited to talk to you about how people can stop wasting money on paying taxes that are unnecessary.
Great, that's my life.
That's good. So tell me a little bit about you and how you got to where you are.
So as I was mentioning earlier, I grew up in Salt Lake City, Utah. Of course, grew up Mormon. So spent 2 years after high school in Paris, actually, teaching Mormonism to Catholics and learning all about rejection, which was great. And then I went to the University of Utah, where I did my undergraduate work in accounting, and went to the University of Texas for my graduate work in accounting. And then spent 6 years at Ernst & Young, including 3 years in their National Tax Department. In fact, the last time we had a major tax reform, 1986, I was in Washington, D.C., actually participating in the tax reform effort. So that was a great learning lesson. And we also trained the accountants around the country, is what we did at National Tax. From there, I went to Pinnacle West Capital, which was at the time a Fortune 500 company, and I was an in-house tax advisor there. I spent 14 years as an adjunct professor at Arizona State University in their Masters of Tax program. And the last 25 years, built an international accounting firm and sold it and built another one. And now we run a network of CPA firms around the country. And as you know, I've been traveling the world with Mr. Kiyosaki. In fact, just got back from Japan with Mr. Kiyosaki and group, and we talk about taxes. And amazingly enough, they're the same in every country, so it's easy to talk about.
Well, there seems to be a wide gap between what like my average CPA knows and what's really available to for deductions. And I want to get into some specific tax strategies, but why, like choosing a CPA, it's almost like choosing a therapist. There can be a wide range of outcomes.
Well, it's like choosing a doctor. I mean, you go from a chiropractor to a heart surgeon, and you have to decide, what do you want? But really, it's a matter of perspective. My perspective is quite different than the typical CPA. Most people are afraid of taxes, and my perspective is that in essence, the tax law is really a series of incentives. And that's all it is. I mean, if you look at it, there's only about 30 pages that raise taxes, and there's 6,000 pages.
How does somebody, if they're searching for a CPA, how does somebody vet them to know that the perspective of that CPA?
Well, what's interesting is like I said, most people are scared to death of taxes, including most CPAs. And so really what I would be looking for is what's their perspective on taxes. To me, the tax law is really the way the government creates incentives to get us to do what the government wants to have done. So if the government wants us to hire employees, they give us incentives for hiring employees. The government found out years and years ago, back in the 60s, that the cheapest way to incentivize people to get something done is through a tax break, whether it's buying a home, whether it's sending your kids to college, whether it's adopting children, or whether it's building low-income housing for thousands and thousands of people. So that's what the government does, is they've used the tax law as a way to engineer the economy and energy and society. And frankly, it works pretty well because you get people putting money where the government wants them to put it.
So this philosophy that comes from you, and I, maybe surely you are the only person in the world thinking this way, but I was first exposed to it from Robert Kiyosaki. He's like, look, I'm doing what the government wants me to do. I'm playing, it's really almost the opposite of a cat and mouse game. Maybe I can hide it here. Maybe I can, hide it. It's a really fresh perspective. Do I shop for a CPA? Do I educate a CPA? How do I get somebody on my team?
Well, first thing I suggest is you buy my book, Tax-Free Wealth, right? And I actually put a whole chapter in there. That was the one chapter that Robert insisted I put in there. was how to find a tax advisor. And the key to a tax advisor, I think there's two keys. One's their perspective. And I think that that's key, because I can't tell you how many times I've had people tell me they were told not to take a legitimate tax deduction because they were advised not to by their accountant or by their tax advisor. I actually heard people tell me that their accountant told them that the way to pay less taxes was to make less money. I'm going, that's got to be the dumbest advice in the history of the world, right? Seriously? I mean, the highest tax bracket's 40%, well, 60 if you're in California, but it's not that high. It's not 100%, right? So of course you don't want to ever make less money, but you do want to pay less tax. So it's a matter of finding somebody with the perspective, but it's also a matter of finding somebody who's interested in you. Because as I always like to say, if you want to change your tax, you have to change your facts. And because it's all fact and circumstances driven. So if I'm going to change your taxes, I need to know everything about you. I mean, literally, I know more than your therapist, because I know about your family, I know about your relationship with your children, I know about your relationship with your wife, because what you're going to do with them all has an impact on your taxes. Everything you do has an impact on your taxes. Every dollar you spend, every dollar you earn, everything you do has an impact on your taxes. So I'd better understand everything about you. So the first thing I tell people is, you want to find a good tax advisor, find somebody who's asking questions about you instead of you having to ask them questions. If you have to ask them questions, you have the wrong person.
You know, I used to be, when it came time to do my taxes every year, it felt like I was going to the principal's office, where I would go in and he would chastise me for all the things I hadn't done the previous year. And I kept searching for I'm like, okay, can you start telling me this before the year? And Jeff, I need you to do this, not as we get close to April, well, you should have done this. If you were to advise people forward thinking of putting your house in order for taxes, what are some things that people can do now to make sure they're prepared for to have a better outcome?
Well, it's not a one-year situation. It's a lifetime situation. So, you know, most people spend their time on taxes deferring or postponing taxes. They do 401ks and do IRAs and they do pension plans and profit sharing plans, which is mostly a complete waste of time. Because if you're going to postpone your taxes, that presumes that you want to retire poor. Because the only way it works is if you're in a lower tax bracket when you retire than you are when you're working. And the only way you're in a lower tax bracket when you retire is if you're making less money. So to me, the whole idea of postponing your tax liability is an idea of, I am going to retire with less money than I have now. And I've just never met anybody who really wanted to do that. Well, the good news is that 90% of the tax law is permanent tax reduction. It's not temporary tax reduction. That's just the easy stuff. I always say easy is a four-letter word, right? Because it's what accountants go to when they don't know enough and they haven't spent enough time studying the law to understand all of the permanent tax reductions that are available. I mean, there's thousands of them, and it's just a matter of finding somebody who really loves taxes and can explain it to you, because that's the other part of finding a good tax advisor is you really need somebody who will sit down and speak English and actually explain it in simple terms. I always say that my goal in life is to make taxes fun, easy, and understandable. And if I can do that, I win, right? And if I can do that, everybody else wins. So here's the thing. The tax law, like I said, series of incentives, right? And most of those incentives are permanent tax reductions. So there are things like tax credits, and there are things like, let me give you an example. Let's say that you were going to go out to dinner. If you don't get to deduct that, you pay tax like you normally would. But if you do, you get to reduce your taxes with that meal being deducted. So if you could shift it from being non-deductible to deductible, that would be permanent, because you're never going to have to pay the government back that money, right? You get that deduction and it's yours forever. And that's the way most of the tax law works. And even those things that we think of as postponing taxes, things that we can talk about later, is like depreciation, where we're taking a portion of the building, and then if we sell the building, we could have to pick it up in income. Well, we can make that permanent. So there are lots of opportunities to turn even a temporary deduction into a permanent deduction just by understanding the law. The challenge is that most people aren't willing to take the time to understand that the law is not this section and this section and this section standing alone. The law is a living animal. It's a living being that works together. It wasn't written by accountants. It was written by attorneys and politicians. And so it's very interactive. So understanding the law, which is what I spend my life doing, of course, is really the key. And then understanding that, look, it's not out there to get you. The IRS may be, but the tax law isn't, right? Congress enacted these incentives in order to encourage you to do certain things. So once you start understanding what those incentives are and how they apply in your life, all of a sudden, taxes get easy.
So if you were to think of the 5 most common mistakes that people make, that or 10, or you know, what are the things that you see most where either doing their taxes on their own or their accountant where they're really missing it?
Well, the first mistake would be doing your taxes on
Okay.
your own, right? It really would be, because not hiring a professional to do something that Einstein said was the most complicated thing in the world. Okay, so it's complicated, Einstein. It's really not simple. Right now, if you have a good tax advisor, they should be able to make it simple, at least in concept. But see, this is a partnership. It's a partnership between you and your tax advisor. There are certain things you have to do because, like I said, if you're going to change your tax, you have to change your facts. I can't change those facts for you, but I can tell you what facts to change. So we have to have this constant relationship. But where it has to start is with a long-term plan of action, what we call a tax strategy, because we need to be looking at not just today and tomorrow, we even need to be looking at beyond your life expectancy, because what happens with your money when you die has an impact on how you're taxed now. So there's nothing that we don't want to look at, and that's why that long-term tax strategy is really the best solution, because that's a comprehensive picture, and everything we do, then everything you do during the day can be a way to save taxes.
Okay, so I'm going to put in this column, we're going to start building a column in my head of the things I need to do, long-term tax strategy. Let's fill up these top 5 or 6 things where people, so number 1, you don't want to do your taxes by yourself online or however people doing it.
Don't do your taxes on your own. That's number 1. Number 2 is recognize that most of the tax incentives are for business owners and investors. Business owners, and actually, to be more specific, professional investors. So the casual investor doesn't get the tax benefits. The employee doesn't get the tax benefits. So I would say number 2 is start a business. Start a business or start investing, whether it's in real estate or whatever you're going to really make your life's work from an investment standpoint. I'm always amazed by business owners. They'll be really good at their business. They'll make all this money, and then they'll just turn the money over to somebody that they don't even know. Could be an actor for all we know, right? And let them handle their money. I'm going, why would you do that? You worked so hard for that money. Instead, what about you learning how to deal with it? What about you learning how to invest? Because that's where the tax law kicks in. See, if you're a professional investor, now the tax law gives you tax benefits that you didn't have as a casual investor. And it doesn't matter what type of investing you're doing, frankly. You just need to find something that you enjoy doing. So I would say number 2 is that you really have to decide, okay, am I going to start a business? Which is so easy to do now, right? Online businesses are a piece of cake. There's virtually no barrier to entry. You can do it on your phone. So either start a business or start investing. So that would be number 2. I would say that, now, interesting enough, the biggest mistake that people make, they own things themselves. So they don't use what we'd call an entity, like a corporation or a partnership or a limited liability company. They just own it themselves. And that produces huge negative tax consequences. For example, if you had a business and you didn't have any type of entity, you would report that business on Schedule C. Well, Schedule C is basically a profit and loss or an income statement. There's no balance sheet, there's no statement of cash flows, there's no other check and balance for it. So the IRS doesn't believe you. By definition, you are not to be believed because all you have is an income statement, which is easy to falsify. Okay, so actually you're 5 times more likely to be audited if you have a Schedule C than if you don't. So get ready for Schedule C. Go set up the entities. This is where you're going to use a tax advisor and probably an attorney at the same time, and you're going to set up those entities. So you know how you own your assets is going to have an impact, probably the biggest impact on how much tax you pay right off the bat. There are several tax deductions that these are the easy ones. These are tax deductions that people miss, and mostly they miss them because their tax advisor tells them not to take them. And to me, that's just astonishing, but every time I'm in front of a crowd, I typically ask, how many of you have ever been told not to take a tax deduction? And then I ask them, how many of you were told not to take the home office deduction? Now, people, home office deduction, that's not much. It's a little bit of, taxes, and it's a little bit of interest. And I get the interest anyway. I don't get the taxes anymore, but I get the interest anyway. And so it's really not that much. What they don't recognize is that by not taking the home office deduction, you're also limiting your automobile deduction. See, this is how these things work together. Remember that if you're driving a car for work, that first drive of the day is a commute, not deductible. The last drive home is a commute, not deductible. Well, what if your first drive of the day is 30 feet from your kitchen to your home office? That's your commute. And the IRS says that's your commute. Now that means that first drive of the day that you have, say, to your first property or your first client, now that's deductible. So you basically, for most people, they'll double their tax deduction for their car if they take a home office deduction. And the home office deduction is a specific deduction that's allowed in the law. I mean, the IRS actually tells you how to do it. So to be told don't take the home office deduction because it's a red flag, first of all, it hasn't been a red flag since about 1997. Okay, so that means that,
And I remember hearing that. It's like, wait a minute, you'll trigger an audit if you...
Exactly. Everybody says that. If you do it right, the IRS will never know you have a home office unless they audit you, because there's no place to report. If you do it right, there's no place to report on the tax return. Now, if you have a Schedule C, you're also going to report your home office. So now you've doubled up your red flags. You've got a Schedule C, which is the big red flag, and you've got a home office, which they're saying, do we believe you that that your home office is legitimate? You instead have an entity like an S corporation, for example, and all you do is reimburse yourself for that home office, and all it says is office expense on the tax return. It doesn't say home office anywhere.
So it couldn't trigger an audit.
So it couldn't possibly trigger an audit. Now, if they do audit you, they will probably ask the question, but that's okay. Make it everything I'm talking about, you want to do it legitimately. You sit down with your tax advisor, you go through the rules, you follow all the rules, you document everything. It's not that hard. I mean, we've helped thousands and thousands of people do this.
Okay. Are there a couple more easy
Yeah,
glaring
let
errors?
me give you a couple of other ones. So meals, okay? Now, any business owner knows that if they go to dinner with their spouse, they are going to talk about business because that's the way we are. We are built that way. And it doesn't matter if our spouse is involved in the business or not involved in the business. My first wife was a musician. Still, I wanted to bounce things off her. Okay, second wife, she's an accountant. Now we're talking about business. We talk about taxes all the time. Either one, though, that's a legitimate business expense because you've had a business purpose for it. You've had a business discussion about it. It's actually necessary for your business. It's helping your business, and you document it. And so as long as you meet those tests, there's something that's deductible. Most people either they don't document it, which then it's not deductible, or they don't take it. Okay, so meals is a big one. We want to be, we don't want to be greedy. We always say pigs are cute and hogs get slaughtered, right? So, make sure that it really is legitimate business.
And documenting is just writing on the back of the receipt, I was with this person, did this thing, talked about.
That's all it is. And then, what do? You take a picture of it, right? And you file it. Right, you take a picture of it, you scan it. Don't keep the receipt because that's going to fade and it's going to be blank by the time the IRS catches up with you. So that's not going to do you any good. So take a picture of it. They love documentation that is scanned or pictures. Another big one is travel. So people travel all the time and they may be doing business and they may not realize that if they spend more than half a day and they're doing business that can only be done in that location, then that makes the trip deductible. I had a client years ago that he said, Tom, we're traveling to New Mexico all the time, and we'd really like it to be deductible. What do I have to do? And I said, well, you're in the real estate business, so spend time looking at real estate and actually do business there. Well, here's what's interesting. So he comes back after the very first trip, and he says, Tom, can we meet? I said, sure. He says, he's so excited he can hardly stand it. He says, Tom, I found a deal. He says, it's going to net me $1 million. I said, and I asked him, I said, so is this a new deal? Is this something he says, no, it's been there for a long time. I just never saw it because I was never looking for it. So see, what the government wants us to do is be looking for those deals. I mean, obviously he's going to pay tax when he does that development, and the government's going to get more money from the successful development than they'd ever pay in a tax deduction for the travel. So it's good for the government. The government's our partner. I mean, the reality is we're all partners with the government, right? They're taking some percentage of our earnings every single day. So we can be a good partner or a bad partner, and they don't care which one, frankly. They're happy to take our money, or they're happy to give us the tax benefit if we do what they want us to do.
That's great. I just thinking where and I am doing this, but like we just shot a series in Italy, and I got to go to Italy and scout that trip before we went over there and shot that trip. And
Sounds like a horrible job.
This is a
really tough job.
A tough job, but it was a legitimate business use of my time and money, and it was for my company, and it was a blast.
Of course, and it doesn't. And here's the thing: you don't have to. I mean, you can still go out at night, and you still, have fun, and you can go, take a side trip to see Venice. Not a big deal, right? As long as the reason that you're there is business.
So, what are specifically for entrepreneurs or investors? What are some of the best strategies that you're implementing with them right now?
So really what we look at is we look at 5 areas that we're going to look at. The first one, we're going to look at deductions. Are they taking advantage of all their deductions? Is there anything they can do to really change what they do on a daily basis so that more of their expenses can be deductible? That's the very first thing we look at, and that's kind of what I call low-hanging fruit. Okay. The second thing we do is we look at, can they generate better income? So when I say better income, most people know that capital gains are taxed at a lower rate than ordinary income. Well, ordinary income is taxed at a lower rate than earned income because there's no Social Security taxes. And then there's tax-exempt income. So you can go all the way from earned income that's taxed as high as 60% all the way to non-taxable income. So one of the things we want to do is look at, is there any way to convert some of your income from a high tax rate income to a lower tax rate income? Okay, for example, let me take you through a situation. Let's say you've decided that you're going to get into real estate, and you decide, okay, I'm going to flip houses. Well, flipping houses is a business. Guess what? Earned income. Well, the very first thing we do, okay, you're flipping houses. So we're going to take that from earned income, we're going to put you in an S corporation, and we're going to take away the earned income. It's now just ordinary income. So now you're not paying the Social Security tax on it. Then what we're going to do is we're going to say, well, look, are there any of those houses that you'd like to rent out? Oh yeah, I'd like to rent some of those out. They're really good properties. Now you're on the inside as an investor, right? Now you start renting them out. Now you've gone from earned income to capital gain because you're renting it out. Now you go, okay, now I'm going to take depreciation, but eventually I'm going to sell that property, okay? So let's turn that into non-taxable income by doing a like-kind exchange, a 1031 exchange. So now we're not going to pay tax at all. And guess what? If you hold that property when you die, if you're still holding real estate when you die, that tax completely disappears. So you've gone from earned income to ordinary income to capital gain all the way to zero with the same investment. It's just a matter of changing some of your facts. Now you have to want to do that, right? You have to want to hold it and rent it as opposed to flip it. But the first one's really easy because that's just a matter of using an entity. Anybody can do that. So that's the second thing we do. The third thing we do is we look at tax brackets. Now, I actually was in South Africa with Mr. Kiyosaki a few years ago, and we had a South African chartered accountant there with us that we'd met previously. And I said, the morning before we go on, I said, so let me ask you a question. Could you hire your kids to do work in your business? Would that be illegal in South Africa? She goes, Yeah, I guess it would. I said, don't they have their own tax brackets? She goes, well, they do. I'm going, wouldn't that be a major tax savings? She goes, that's fantastic. I'm going, it's not that hard. I mean, we have a $12,000 standard deduction in the U.S. Every child has one. It's what I call an underperforming asset, okay? Because you've got tax brackets in your children or your elderly parents that probably aren't being used up. So why not use those low tax brackets? Everybody gets them, and Donald Trump gets low tax brackets, right? Bill Gates gets low tax brackets. Now, he uses them up pretty fast, right? But they're there, and everybody gets those brackets. Well, I had a client once with 8 children. Well, that's 8 sets of tax brackets and 8 standard deductions, and we saved them literally over $100,000 in tax every single year just by using their tax brackets. So that's another thing to look at is, how could I use my tax brackets? Then a fourth thing we look at is, are there tax credits? Is there tax exempt income? Are there things that are really not taxable at all that we can take advantage of, whether it's solar credits, whether it's credits for education, whether it's child credits, whether it's adoption credits, whether it's work credits. I mean, there are all these different credits that most people don't even know about. And it's just a matter of sitting down and seeing, what can I do? Then if all else fails and we still have tax liability, we'll postpone it. We still want to postpone it because that's still better than paying it now. But what we want to do is we want to take those first 4 areas and really focus on those. And then if we can take care of those, that's typically we can get people down to a 20% or lower tax bracket, regardless of how much money they're making.
Wow, this when I and again this philosophy, I'm really trying to get it that all you're doing is allowing the government to incentivize you to do what they want you to do. And I get this, this creates our economy. They want people to start businesses. They want people to develop to develop new projects. What do you think the new Trump tax law? What's the impact that's having, if any?
Oh, it's actually having a huge impact in certain areas because there were big winners and big losers. The big losers were employees. We all know that. We no longer have employee business expense deductions. We got limited on our tax expense. We got limited on our home mortgage interest. So employees just got hammered. They did with the Trump tax bill. Who won? Surprisingly enough, real estate investors won. Now we have bonus depreciation on real estate, which means that if you invested, let's say you went out and bought a duplex for fourplex for $1 million, okay, and you put $200,000 down, your first year deduction is likely to be $250,000 to $300,000.
Wow.
Even though you only put $200,000 into it, because the bank doesn't get a tax deduction, you do as the investor. So you get this huge tax deduction the very first year. It's the only time in history that real estate has been a better tax benefit than oil and gas. Now, oil and gas is another one. Oil and gas used to be that you got an 80% deduction the very first year you invested. So if you put $100,000 into an oil and gas deal, you got 80% of that as a deduction, which is worth about $32,000. Now it's 100% because on top of the oil benefits, you still have depreciation. So now you have the 80% that was the oil benefit, and you have, which we call intangible drilling costs, and you have the 20% that's actually equipment. So that's deductible now too. So basically you put $100,000 in, you get a $100,000 deduction. So again, it's a matter of looking at what does the government want me to do and going ahead and doing it as long as it fits your investment strategy. So we don't ever want the tax tail to wag the dog, but I'll tell you what, it's a pretty big incentive. So the big winner was real estate. We also have the Opportunity Zone credit, which is Opportunity Zones, which is a huge tax benefit for real estate. People who want to invest in developing areas. Another one is small business got big tax benefits because they got this 20% deduction. 20% of your income is now no longer taxable if you're in business. If you're an employee, 100% of your income's taxable. If you're a business owner, 80% of your income's taxable. So if that's not enough to encourage you to be in business, I don't know what is, because to me, I'd much rather be taxed on 80% than 100%. And then we have other tax benefits, like now a small business, somebody who makes less than $25 million gross a year. Now, we don't typically think of that as too small of a business, but you can make up $25 million a year in gross income and still be on the cash receipts method. You can actually, if you have inventory, you can deduct your inventory when you buy it. I mean, there's all sorts. That was a huge one that nobody ever talks about because it's kind of obscure. But there are little nuggets like that in the tax law that if you understand the tax law, all of a sudden become big. Another one is, you could start you can start a company where even if you already have a company, and if you invest the money back into the company, after 5 years, you can sell it and pay no tax when you sell it.
Okay, wait, say that again.
Okay, so let's say you've got a company, okay? And we have to, of course, we got to follow the rules. We got to go through all the details. What we're going to do is we're going to be a C corporation. Well, this is actually not a new law. What's new is now C corporations only pay tax at 21%. That's what the big companies pay, right? 21%. So now it makes sense because I'm okay paying tax at 21%. I'm not paying tax at 35% like I used to. So I got this, now it's okay to keep putting my money back into the company. After 5 years, I can sell it and there's no capital gains tax.
Wow.
And it just goes on and on. So businesses and real estate, they were the two big winners.
So I'm telling you, this is where, our entrepreneurs are always focused on making more and forgetting that sometimes you can have significant holes in your bucket that are draining away. Sometimes the best way to make more money is to stop losing money that.
Well, it's actually, how much you have to make, how many sales you have to have. If you think, if your net profit is 20%, then in order to increase your net profit from $200 to $220, you got to sell a lot more product in order to get that up by $20. But if you just reduce your taxes by $20, you've done the same thing. And this is why I always say the fastest way to put money in your pocket is reduce your taxes. And it's actually the easiest thing in the world. Typically, we start working with a client, within 3 months, we reduce their taxes by somewhere between 10 and 40%. That's typical. That's if they're a business owner. Now, if they're not a business owner, they're an employee, and they're only going to be an employee, I can do nothing for you.
So how much money does somebody need to be making annually before they should, I'm assuming if somebody is making $30,000 a year, having a corporation isn't going to help them that much. What's the dividing line?
Yeah, if you're making $30,000 a year, you're probably not paying any taxes. Okay,
Right.
That's the way the tax law works, right? The tax law is a graduated, progressive tax schedule. So, but if you're making, $150,000, $200,000 a year, you ought to be seriously thinking about your tax liability because it's probably your single biggest expense.
What else do you wish that people knew? Is there something that if you could stand on a mountaintop and let people know, what would it be?
Well, one thing I do is most people are scared to death of taxes, and particularly the IRS, right? So can we do a little test here?
Yes.
All right. So how would you like to never, ever have to worry about the IRS?
I would love that.
Okay, so here you go. Repeat after me. I will never speak to the IRS.
The IRS.
There you go, because that's not your job. That's my job. See, it's like you have the opportunity to put a professional in there to do that job for you. And for me, IRS doesn't bother me. I don't get nervous about the IRS. I don't get emotional about it. I'm a professional. I've got lots more experience than any IRS auditor. Okay, for you, it's brand new.
Yep.
So it's a little bit like, you were playing basketball one-on-one and you could hire LeBron James. Wouldn't you do that? And yet people go, no, I'm just going to do it myself because I'm going to save some money. Well, you're going to pay in just the emotions of it. You're going to pay in the time, and you're going to end up paying a lot more tax if you don't have a professional on your side. So it's really about building a team. Building a team, I think, Robert always says that business is a team sport, and there's no question. And when it comes to a tax professional on your team, I just don't think there's anybody that's going to have a bigger impact on your financial situation other than maybe your spouse.
I think you're probably right. I love what you're doing. If people want to pursue this more, how do they find you, or are you hiding from? Or you got some pretty big clients.
I don't hide from anybody. So the very first question you asked is, how do you find a good tax advisor? And what I found over the years is that is the single hardest thing for people to do. That is the number one question I get, whether I'm here or in Europe or in Africa or in Asia, it doesn't matter. That's the number one question I'm going to get. So we decided to take that on. Okay, so we actually have a network of CPAs. So if you want the easy button, you just go to wealthability.com. The company is wealthability.com because it's all about your ability to create wealth. So you go to wealthability.com and we will, at no charge, help you find a tax advisor.
That is so great.
There you go.
Hey, Tom, this has been terrific. Thank you so much for taking the time to talk with us.
Absolutely. Happy to do it.
Your episode 6 bonus interview is with investor Scott Stewart, who has a simple, if unconventional, message. He says you should ignore 401ks and mutual funds. The 1% are the 1% in many cases because they think about money and invest much differently than we do. And there's one simple step you can take right now to make sure your money works for you on autopilot day and night forever. Take a look, and thanks for watching.
Scott, thank you for being here.
Thanks for having me.
Looking forward to this. So tell me a little bit about who you are and what it is that you do and how you got there.
Oh, boy, that's a big question.
It is.
So I've always been excited about investing since about the age of 12. It was something that just enthralled me, that idea of money making money rather than you earning the money for yourself. And it was a long journey. I thought it would be a great career for myself. And so about age 23 or 4, 1987, I started out as a stockbroker and went into investment banking. And it was interesting, the deeper that I got into the financial world, your friends, neighbors, relatives, they would meet you and know what you did for a living. And everybody views you as an expert, and the more qualifications I got, the more designations and letters I put behind my name, the more Series 6s or 7s or 25s registrations that I got, the less I really felt that I knew about the marketplace. And I knew a lot about regulations and rules and how to process transactions, but like a lot of people, I wasn't making a lot of money, and I always used that as a little bit of a disconnect. And so I tried to figure out how I could get out of the industry of selling people on investments and figure out how to make the investments work for myself. And that was a long journey. There was a lot of false starts along the way, but that was always my end goal, and that's one of the things that I'm the most proud of today. I never really set out to be a rich person or drive Ferraris or live in mansions, but I wanted to be able to support my family off of my own efforts, off of trading, and not have to rely on a job. And I believed in investing. That's why I went into it as a career, and I thought that this was something that could create financial independence for not just for my clients at the time, but for me as well. And it wasn't happening in either case. It wasn't happening for my clients, and it certainly wasn't happening for me. And I started to feel like, is investing in general just a scam, or am I maybe approaching it incorrectly? And that's what I found, is like, no, there's empirical evidence that there's a lot of people getting wealthy through investing, but they must be doing something different than I am. And I always thought about the phrase being exceptional. As you look in life at a human being, whether you're talking about personal, physical, spiritual, mental, financial, whatever it is, there's only about 1% of the human population that we would view as exceptional. And of course, the 99%ers are the masses or the average or the norms. And I was like, well, what does it take to be exceptional? And you look at these people, whether it's an actor or whoever you say, hey, that's an exceptional person, they do things differently than the masses. They're always the salmon that's swimming upstream. When the rest of the world is going this way, they're all heading in the different direction. I'm like, well, I don't really know as an investor what I should be doing or what I need to do to be successful, but I know what I shouldn't do. You know, I know that this whole concept of 401ks and mutual funds that's been pushed on us as the solution, it can't be the answer, because everybody's doing that and nobody I know is wealthy. Nobody I know is retiring early at 50 with more money than they know what to do with. So that was sort of the epiphany that I had, where I got to go find a different approach to investing and make this work for myself, so that I feel good about telling others about, you know, what is this opportunity and why are you kind of stupid if you don't take advantage of it. So it was a journey.
So I'm assuming the journey was not then you started making millions of dollars instantly and it was great. So take us on the learning curve.
If you ask my wife, she would say I'm cheap. I like to call myself thrifty, but she calls me cheap. And I am the proverbial guy that will drive around town all day long spending $7 in gasoline to save $3 at the pump. And everybody told me, listen, you wouldn't figure out how to become a doctor on your own. I mean, we all understand that there's a process and a cost to becoming an expert at anything. Trading's no different. And I was like, well, I can figure it out. There's libraries full of free books. I'll figure this out. And so I had a lot of false starts, and I paid a heavy tuition in the School of Hard Knocks. A lot of false starts, and blew up several very small accounts initially, not knowing what I was doing. Finally realized that I probably needed to hire a mentor, and anybody that's good at anything is expensive. And I remember it was a lot of money for me to come up with to hire somebody that was quote unquote an expert at trading. And I had to sell a car to get enough money to start trading again, and had this little account, and we did my first trade, and we made I remember it was like $22. And he was ecstatic. He's like, look at that, that's amazing, what a good job you did. And I'm just like, it's $22. And he's like, and I always remember this, he said, you need to trade with the intent to trade well. If you trade well, if you play the game correctly, the financial results will follow. But if you're trading because you need a paycheck, you're trading because you need X amount to make the mortgage payment next week, you're going to have a tough go at it. So I've always remembered that, you know, I want to trade technically correct. I want to do the right things in the right ways. The money will follow. And so it did, you know, but yeah, I wasn't rich overnight. You know, the next trade was $32, then $50, then $100. And you start getting to that point, and I think it's different for everybody, depending on your lifestyle, you know, how much you need to keep a roof over your head on a monthly basis. But when you start getting to a couple $1,000s a month, you're like, wow, this is real. Like, this could really allow me to take care of my family. And that was the big boom for me. It was about $2,000 a month where I'm like, I could really turn this into something powerful. And then you put more effort into it and you get better results with more effort, and it was a process. But it is a process. And I think no matter what we say as individuals, we all are enamored with that get-rich-quick thing. You know, everybody wants to be a millionaire tomorrow, and it's not how it works. There's a tremendous opportunity in the market, but it isn't a get-rich concept or strategy. It does take time, it takes effort, and it takes repetition. It takes a long time to knock down 100 or 200 or 300 practice trades to the point that you feel comfortable doing something. And you know, it's like anything in life, you got to put in the effort.
So what kind of trading do you do now?
So there's been an evolution, and the evolution continues. It just continues and continues. I started, like most people start, with buy and hold. You know, the old mantra, you buy low, you sell high. Go find a good asset, no matter what it is, at a low price. Buy it, hold on to it. At some point, it's going to be worth more. You sell it, you pocket the difference. And as I did that, I'm like, I'm doing everything that they tell me to do. The wealth is not coming. What's going wrong? And I realized that I needed to shift my focus from trying to build my net worth to trying to focus on cash flow. I was so net worth oriented. Every year I would look at my net worth statement. My net worth's up. My net worth. You can't feed your family on net worth. I would rather have a zero net worth and have something that's creating $30,000 or $40,000 a month of cash flow for me to live on. And so I reoriented my trading a little bit. And I learned options. Options are a way to control assets without actually having to own those assets. It's more of a professional approach, I believe, in the marketplace. You know up front going into a trade what your max profit is, what your max risk is. So it allows you to approach it from a professional standpoint. And then from options, I've gravitated into futures and Forex, and there's all different venues to that as well. One of my bigger frustrations right now as a full-time trader is people ask me all the time, well, what's the best trade? What's your favorite trade? And I'm like, well, my favorite trade is probably not even going to be workable for you because I don't have a day job and I can sit at my computer all day long and push buttons and trade. You probably have a life, and even if you have the ability to sit in front of your computer all day long, you may not want to do that. This may not be your passion. So it is a process of finding what works best for individuals, but it's interesting to me. I'm 53 years old. I've been at this for about 35 years now. I'm still learning. Like I'm still growing in terms of understanding opportunities that the market presents, and it's such a dynamic process. So I still learn new concepts and strategies today.
So let's talk about the basics of options. A lot of people when they hear that, options, you can lose all your money, and they shy away from it.
Sure.
And I mean, most people probably should shy away from it, but
Yeah.
I know that there's a lot of people that we're talking to that would enjoy taking an active role in managing their money. So walk us through options. And you also don't seem like a real high risk taker.
Well,
as you talk about being frugal,
right.
And
so I think your question is sort of a two-part question. It's number one, what is this risk component to it, and then how complicated are options really? So the risk component, I take umbrage. That's a big fancy $6 word, but I take umbrage with the fact that people say XYZ investment, whatever it is, commodities, futures, options, that's risky. I would throw out there that there is no risk in any investment of any kind. Risk is not innate. It does not exist inside of investments. These are innate objects. They're just commodities. The risk comes from what you and I as individuals do with that investment, how we approach it, whether we manage it or not, whether we just throw money in and hope for the best. We as individuals are the ones that decide what the risk inside of an investment is. And options are a perfect example of that. I can ask you right up front, what do you got to work with, $1,000? You tell me. How much of that would you be willing to risk? Everybody's different, right? Some people say, I'll roll it all. Some people would say, man, I wouldn't sleep well at night if I lost $100 of it. It's my life savings. Fine, we can build a trade with that $1,000 that only puts 100 of it at risk. But you decide the risk. So that's a big paradigm shift for a lot of people, that we can decide what risk we want to be involved in. The market doesn't decide that for us. And then with options, it's like anything. Whatever you do for a career, there's probably some buzzwords that you use in your industry that maybe other people don't necessarily understand what you're talking about. I always like this saying. I really believe this to be true. In life, there's very few things that are hard or difficult. I really believe that. It's just everything at some point in life is new. And when you're confronted with something that's new, it can seem overwhelming and really, really complicated. I think it was Warren Buffett that said that as human beings, we take things of great value and we purposely overcomplicate them. Because if it's of tremendous value to us, it must be complicated, right? Lawyers and doctors are great at this. They're fantastic at this. Because if a lawyer would use plain English, we could do what they do for ourselves. I went to the doctor a while ago. I had a checkup, and he said, well, you got this. And I'm like, I don't understand any of the words that you're using. Please, and that there's a word in the English language that I would understand that means the same. Just speak to me like a normal person, right? But we purposely overcomplicate things. And that happens with options as well. The great thing that we have with trading is that we can paper trade. We can virtual trade. We can do real trades in the real market with real prices and real results, real profit and losses, but with fake money. And so we can develop pretty high levels of competency with options trading strategies before you ever have to put any real money at risk. And so again, the first step is always the hardest. But I like to say that it's not complicated. It's just new. It's just something that you have not done before.
Well, and you have that reputation that we have some mutual friends, and what I heard about you is that you're really great at taking complex strategies and making them simple. So almost the inverse of the doctor and lawyer is like making it so people can understand it. So let's just stay on options for a minute, and then we can go. What? So I'm getting a sense the thing that you suggest to people is practice paper trade in the real market for a while to really get. One of the things that keeps coming up from this is education. It's like people need, if you're going to do this with your money, you probably need to figure out how to get some education. So with that as a platform, walk somebody through, how you work with somebody that wants to trade options and is looking to do what you're doing.
Well, the first step is, are you interested in more education, in self-education? I saw a USA Today poll a while ago. It's been a few years ago now, but they asked the question, they did a poll, what is the age that the average human being stops learning at? And the answer was 16 years old.
Ouch.
And if you have a teenager at home, you already know that was the answer, because I've got a 15-year-old son at home right now. And the only thing I hear from him most of the time is, I know, Dad, I know. Because at that age, you know everything, right? And so I ask students a lot of times, I'm like, do you feel like you are a objective, open-minded individual? And everybody says, well, of course I am. And I call them to their face a bold-faced liar. Because as grown adults, we've all developed biases and prejudice and belief systems. Even if you've never invested in your life, you have a preconceived idea about what's right and wrong, what's the good things, what are the bad things. And so it's hard, as we become grown adults, we've all had successes in our careers or lives and developed competencies in one form. And it's hard to say, hey, this is a new area. I'm coming in just like a child with an open mind saying, hey, teach me, show me what to do. And if you can get there as a human being, that's step one. Step two is saying, yeah, I crave that additional knowledge. I crave that growth. I was of the mindset that, man, I didn't really enjoy high school. I really didn't enjoy college. And finally, when you're done, you're like, well, I'm done. I don't ever need to do that again. And if you can develop that mindset that I want to grow as a human being, I want to gain additional knowledge, then that's step two. Step three is starting with very, very basic trades. So we start with very small, very simple trades, and we say practice that for 10 times. And the big thing is a hands-on coaching approach. That's the big thing. There's libraries full of books. And if we could figure out how to gain competency through reading, I just give you the book and say, good luck, you're set for life. It's not how it works. Colleges have built a billion-dollar industry on the fact that you need to sit in front of a professor in a live format. We can't just hand out books. And so the real thing comes with that hands-on approach. And the first time anybody does anything new, the first time anybody does a trade, it's very similar feedback. Like, I don't know what to do. Push that button right there. I don't know what that button does. I didn't ask you if you know. I said just push it. Okay, and then you see the result, and they say, yeah, I see the result, but I don't know how I got it. Great, let's do it again. What button do you push? Oh, I know what button to push now. I still don't know what it does. Nobody asked you, just push it. And by the fourth or fifth time, you're like, I kind of understand this. But it does take, there's two ways to learn things in life. There's an academic approach, and then there's a hands-on approach. And most of the things that we learn in life is academics. We sit in classrooms, we listen to lectures, we read books, we watch videos. You've got to have an hands-on experience with trading. You can't watch videos all day long. You can't read books. You have to have somebody that can say, hey, do this right here. Let me show you. I'll put your finger on the button if we have to. So that's the big distinction. That's where I see a lot of people fail, is they've got every book in the world on trading, and they're no closer to actually doing real successful trades.
So how do you make money from like an options trade? Literally, what's the mechanics of?
So one of the big components in the stock market is this underlying knowledge that a lot of people don't, I think they understand, but they don't process. And that's the fact that the market is a zero-sum game. And zero-sum is just a real fancy way of saying for one person to win, one must lose. So I always love it when the market crashes, we have a big down day, and CNBC always puts the same headline on, $1.2 trillion was lost in the market today. And I always chuckle and think, man, we should We should hire somebody to go look for that. I mean, where did it go, you know? Nothing was lost in the market. Money doesn't disappear. It just exchanged hands. Conversely, if you make $100 today, that didn't just appear out of thin air. Somebody had to lose that $100 for it to appear in your pocket. So it is a zero-sum game. For one to win, one must lose. Well, the natural inclination that we're all just raised with is to buy assets. That's the key. We need to buy assets. We need to buy stock. We need to be buying real estate. We need to buy options to profit from those positions. We take the opposite side of that trade. So if we understand that for every buyer there must be a seller, for every seller there must be a buyer, we want to be the seller of those options. Because we know historically, and this is from the OCC, the Options Clearing Corporation, we know that over time about 83% of all options that are purchased, they lose money on those. So if I know that beforehand, what side of the trade do you want to be on? I want to be the guy that's selling you the options. If you think you're going to make money off of it, good luck. I wish you well. But I know that 83% of the time you're going to lose money, and conversely, 83% of the time I should make money. So we take the other side of the trade. We sell options, and we receive income up front from that trade. So I can tell you, when I put a sell together with an option position, what the maximum profit of that trade is going to be, and I can tell you when it'll appear in my account. That's pretty important, especially as a full-time trader, because I got a budget like everybody else. I got a mortgage. I need to know what my income potential looks like in a month to be able to feed my family and pay my bills.
So, are the majority of your trades in options?
Most of them are in options because it allows me to control the risk and the reward. I know what the potential return is before I get into the trade. I know what the risk is before I get into the trade. I'm the one that sets those parameters. So if I'm unhappy with the result of a trade, it's not the market's fault, it's my fault. And then in addition to that, it allows me a greater window of profit potential. You can sell options in a way, in a structure, that can allow you to make money whether the market goes up, down, or stays the same. Now that sounds crazy if you don't understand options. How can you make money regardless of what the market does? But it's just called bracketing. It's saying, hey, I don't really know where the market's going today or tomorrow, but I feel comfortable that it will stay within a certain specified range. And as long as it does that, I'm going to capture an income from that. So it's maybe, analogy-wise, it's the difference between trying to throw darts and hit a bullseye versus just trying to hit the broadside of a barn. It's easier to hit the broadside of the barn. It's an easier trade. It's a higher probability of success trade.
So during the course of a day, you're active, you're involved, you're trading. How long are these options? Are you in and out of them in a very short period of time, or are you holding, selling them and waiting them out?
Right. So one of the things that I love about trading, it's incredibly flexible. In terms of being able to make money with options, it's a very flexible trading vehicle in that you can tailor the duration or the time frame of these trades to whatever you have in terms of lifestyle. So I've met a lot of people that are like, listen, I have a busy life. I have a full-time job. I'm working 70 hours a week. Or maybe I have the time, but I'm not inclined to be sitting in front of my computer all day long. We can put on 30, 40, 50, 60-day trades. These are trades that you maybe just need to pop in and check maybe once every 3 or 4 days just to see what it's doing. I have the luxury now of not having to go to a full-time job. I love trading, so I sit in front of my computer all day long. And so I'm doing a lot of shorter-term trades too, as short as maybe 1 or 2 hours. But the flexibility is there to build a system that customizes or works for you. And I think that's one of the challenges. That's one of the great things about having that education, because everybody comes in with the same thought. Look, just tell me what the best trade is. Just tell me what the best way to, and there is no best way. It depends on your risk parameters, the amount of money that you have to trade with, and really how much time do you want to put into this? I say I don't have a full-time job. I really do. It's trading. I'm at my computer from 7:30 in the morning until 2 in the afternoon Mountain Time, trading my accounts.
What could somebody, I want to set a goal for somebody, like what's this worth? What could somebody reasonably expect if they're willing to invest the time in themselves and the education, and they think like, I would enjoy sitting and in trading all day.
Yeah.
What's a reasonable expectation of what they could do in terms of
So rate of return, how much can I make? That's always the first question. Of course, it's the hardest one to answer. There's no guarantees in life. There's certainly no guarantees in trading. But we know what the potential of options trades are, and that's where we start with. And so it's interesting, in our Kiyosaki cash flow program, we're just now, this week, we are coming this Friday to the close of our 1-year anniversary with that program. And we've done over 200 trades over the last year inside of that program. It's a sophisticated trade. It's called an iron condor. But it's interesting, I think and again, I don't have the final numbers yet because we haven't quite finished, but I'm thinking that we're going to come in somewhere around 95% success rate. So in 200 trades, 95% of those were winners for us, and we should clock in somewhere around 40 or 50% for the year annualized rate of return. Now, one of the things that I always think about is the rule of 72. It's a real easy, simple back-of-the-napkin computation that you can do. You just simply take the interest rate that you're earning, you divide it into the number 72. It'll tell you how long it takes you to double your account value. So if you're earning 7.2% a year, it's going to take you 10 years to turn that money back. If you're earning 10% a year, it'll take 7.2 years to double your account value. Well, at 24% a year, your money doubles every 3 years. At 36% a year, your money doubles every 2 years with that compounding effect. So you only have to double $7,000 7 times to turn it into $1 million. Wow. And one of the things that I see with a lot of people is they say, boy, I can see how this would be great for me if I had $1 million to go start this today, but I don't have any money. And I always like to say, if you had $1 million, you wouldn't need it. You should be on the beach right now somewhere, right? It is the fact that you don't have $1 million that means that you really do need this. It's interesting, people ask, how much money do I need to start with? And I'm like, you're going to start with whatever you have. That's where you start. I don't know if you have $1 million or you have 1,000, but that's where we start. The key is just to get started, get that compounding effect taking place, and then we can sort of figure that cross point, on the graph of what's it going to take you? Is it going to take you 15 years until you can replace your income from your day job, or is it going to take you 15 months? I don't know. It depends on the amount, but the key is to start. And our goal, we've surpassed our goal tremendously this year, but if we can make 3% a month, 36% a year, and double an account size every 2 years, it doesn't really matter how little you start with. It's enough to get you to your ultimate goal. The question is just how long would that process take? But I think that's the light at the end of the tunnel for a lot of people. You look at how much you think you need in retirement and where you're at now, and people just get depressed. They're like, that's not going to happen. There's no way I'm going to get there. Well, we can do one of two things, right? You can figure out how to bring in 3 or 4 times as much money as you're currently earning so that you can get to that goal, or we can just figure out how to make better rates of return. And it sounds crazy as you get started, that mindset, that paradigm shift of, hey, we're trying to build trades that have the potential to make in 1 month the return that most people would be happy with in 1 year. But that's the dynamics. That's the key of options trading and the strategies that we employ.
So you mentioned earlier Forex.
Right.
And I know nothing about Forex. How active are you in that? What's the...
So that comes back really to your personality, and that question that people always ask is, well, what's the best thing to trade? And there's no right answer. It depends a lot on your lifestyle and your risk propensities and your personalities. But I love Forex. Forex is currency trading, or what is sometimes referred to as pairs trading, but it is a dynamic market. There's a lot of leverage there, and it's a 24-hour-a-day market. It starts up on Sunday evening, and it just keeps going until Friday afternoon, 24 hours a day. And so there is a dynamic there. I thought I was a very disciplined person until I started trading Forex, and then you'd get up at 2 in the morning to go to the bathroom, and then on the way back to bed, you'd be like, I'm just going to check the markets just for a second. And then before I knew it, it was like 6:40 in the morning. My wife's yelling at me to get the kids up for school. And I'm like, I'm going back to bed. And then I'd wake up at noon and she's like, what are you doing with your life? So it takes some discipline to trade it. But when you have the time to do it, leverage is like risk. If we can control the risk, the more leverage we can have, the better off we can be. You can do very small trades. You can do $25 trades in Forex and have a real, actual, decent rate of return. So in terms of potential, there's probably nothing close to Forex, but it's not always where everybody starts. It's a 24-hour market.
So are the skills that you use in your regular options trading, are they directly applicable for the Forex market?
Absolutely, yeah. So one of the big epiphanies that I had that was very helpful for me in just my self-education process was this idea or this concept of differentiating between underlyings, the assets that you happen to be trading, and strategies. And I always thought that the question was, well, what's the underlying? What should I trade? Should I trade Forex? Should I trade futures? Should I trade commodities? Should I trade options or stocks? One's got to be better than another, right? And the real answer is it's not really about the underlying asset that you trade. It's about the strategy that you employ on that asset. And once you get a solid strategy down, it doesn't really matter if you're trading oil or precious metals or cattle or options or stocks. It's the strategy that is going to make you successful, not the actual asset that you're trading.
Can you give us an example of a strategy?
So the real key that we like to use is this iron condor trade. And the iron condor trade is a simple probability trade. It simply says that I'm humble enough to admit that I don't know what the market is going to do tomorrow, let alone next week or next month. And so rather than trying to pick a direction, rather than trying to say, I think this is going to go up, I'm going to buy it, or I think it's going to go down, I'm going to short it, we do what's called an iron condor using options. And that's where we set up parameters. We say, I don't know where this thing's going, but I can look at tools, mathematical tools like standard deviation. And those kinds of things will tell us probabilities and say, listen, this is where that asset's at today. We don't know if it's going up or down. But we do know that there's a certain probability or a statistical chance that it will stay within this defined range over this specified time. And we can define that probability. It could be 80%, it could be 95%. And that's the trade that we build. So again, I love this concept of thinking like an exceptional person, a 1%er, if you will. And the phrase that I always love is, sometimes the more educated you get, the more uneducated you sound to the 99%ers out there. You know, people say, well, what are you trading? Well, I'm trading Amazon, I'm trading Apple, you know. Oh, so you think it's going up? I don't know. I have no idea. Well, you think it's going down? Clueless. No idea what it's going to do. But I do have a high confidence level that it's going to stay in a certain range over a specified time frame. And the way I've structured this options trade, it can go up, it can go down, it can stay the same. But as long as it stays in that range, I'm going to profit from that trade. And I know what the profit is up front before I even do the trade. And that's critical. That's critical.
So right now, tell me what's coming for you. What's the next step? What are you most excited about?
There's a lot. There's a lot that's coming down the pike, and I'm really excited about it. It's been a long time coming for me. I feel really, really blessed to have had the opportunity to work with a lot of the individuals that are involved with Paradigm Press. I really believe that we have one of the largest brain trusts, mastermind groups here, that's ever been assembled anywhere in terms of investing prowess. There's some amazing, amazing individuals here in this collective. And so the idea is, how do we get all that knowledge and that wealth of information simplified, distilled, and out to new individuals? And so we've got a couple of really exciting things coming. We've got one with Grant Cardone that is a real estate product. That is, how do you make money off of real estate in the stock market, where with a push of a button you can get in and out of your real estate investments and maybe have the opportunity to make 5 to 10 times the cash flow potential off of that real estate as you would if you owned an actual rental property.
Wow.
So it's pretty exciting. There's a lot of cool things coming our way.
I love the whole concept that, and you know, I'm a big Robert Kiyosaki fan, and I love his focus on cash flow. I love what you guys are doing with it. I think this is the way you directly improve people's lives, is helping them increase the amount of money they have available to them.
I do. I have loved, and I am very appreciative of the opportunity that I have to be involved in this process, because most of my life I've been a trader. I sit alone at home in front of a laptop, and there's not a lot of social satisfaction that comes with that. And it's so exciting to see people who have been a part of Robert Kiyosaki's cash flow program, and they come up to us and they're like, "You changed my life. This process literally changed my path in life, and you've changed my whole financial future." It's like, okay, I'm not a doctor. I'm not out saving lives every day. That's about as close as it's going to get for me, you know? Thank you.
It doesn't get any better than that.
That keeps me going into tomorrow. Thank you so much. So yeah, it's a tremendously gratifying thing to take people from financial illiteracy to literacy and have them watch their eyes open and see what the real potential is. Because I think we have that wonderment as a kid, you know, and then we grow from adolescence to adulthood, and we just get in these ruts in life, and it's the water cooler experience every week at work, you know. How'd your weekend go? Same old, same old. How about you? Yeah, same thing. All right, see you next week, you know. And just to see that wonderment come back to grown adults and say, wow, I can do whatever I want financially. And if I can do whatever I want financially, I can do whatever I want in any other aspect of my life too.
That's right.
Yeah.
Scott, good for you. Thank you so much.
Thank you for
being here.
having me. I appreciate it.
To see the next episode in the Wealth Breakthrough series, check the video right there next to me. I think you'll love it. Continue to believe, and I'll see you there.
The biggest thing going on in the world right now is debt. In particular, is debt a good thing or a bad thing? Well, it depends what you do with the money. If you borrow money and you can invest it